Business backdrop, that name is down by 0.4%. And your third and final call from Melius Research, raising its price target on Broadcom to 283, saying the company is positioned to see accelerating sales in AI semis. That name is up by about 1 full percentage point. Sticking with chips, NVIDIA earnings coming after the closing bell. Investors are waiting updates about AI spending and how China export controls could weigh on the chip giant. Joining us now is Gil Luria of D.A. Davidson. Gil, welcome back to the program, sir. What's the number one focus for you later on this afternoon?
China. We really don't know what the level of restrictions are on NVIDIA selling chips into China, which chips they can sell, when can they start selling them, can they sell them to any Chinese company, can they sell them into China? We really don't know the answer to that. And even though NVIDIA reports that only 13% of their sales go to China, those are direct sales to that are invoiced from China. We actually suspect it's more like a quarter of their revenue goes there, and that's the highest level of uncertainty. We know they took a big write-down earlier in the quarter, $5.5 billion. That represents at least $15 billion of sales. And we know that there's legislation coming to further restrict them, regulation coming to further restrict them. So we really want to hear from them, what chips can they sell into China and when can they start selling them?
Out of interest, how many of their chips do you think end up there anyway? With the DeepSeek renovation at the start of this year, Gil, there was something that Jensen Huang and NVIDIA said. They said it was amazing to see, basically, I'm paraphrasing, and it was export compliant. How many of their chips just end up in China anyway?
So when the 13% is direct sales into China, we believe those represent the H20 chips that they use to be able to sell. We suspect that just as much arrives in China via Singapore, Malaysia, other countries where resellers buy NVIDIA chips and then sell into China. They're not supposed to do that. And part of the new regulation and legislation coming out in the US is to prevent that from happening, is to put trackers into the GPUs, limit which resellers NVIDIA can sell into. So the impact is a direct impact, but there's also an indirect impact on NVIDIA's ability to sell into China.
Morgan Stanley says this inability for the H20 chip to be sold into China is something that analysts haven't yet fully appreciated and says, quote, there is simply no offset to this. Do you agree with that, or do you see there's another market where NVIDIA can make up the lost?
It's a timeline issue because we do see these bigger agreements made in the Middle East with these Gulf states that are talking about eventually picking up millions of GPUs, but that's not going to happen overnight. And China has already been buying millions of GPUs. So there may be a little bit of a gap between when China demand starts falling off and when the Gulf demand starts picking up. And that's what NVIDIA is going to have to navigate. And they have a rich, diverse customer base, but that is the biggest challenge for the next few quarters.
Well, looking at the timeline, when do you think at least the beginning of that narrative can start to materialize?
It takes a long time. The Gulf states are starting really from a standing start. So they can start planning those big data centers now, but they're at least six months to a year out from having any substantial demand for NVIDIA's chips. So it's at least that long. And to ramp up to millions of chips, that's probably several years.
So there's the issue of China, which definitely will dominate the discussion and the narrative potentially after the earnings. There's also a question of their main customers, which has been the hyperscalers. It was interesting to me that you think the conventional aggregation of some of these hyperscalers isn't going to be as relevant as it has been in the past. Why did you say that?
So the Amazon, Microsoft, Google are the big hyperscale customers for NVIDIA. Microsoft CapEx is already starting to flatten. Amazon is expecting to flatten. That doesn't mean they're not building a lot of new data centers. They are. It's just they will continue to build them at the same very high rate that they have been at over the last couple of quarters. The places where demand is still growing are companies that are actually using the technology for their own product, namely Meta and Tesla. Meta makes better ads that are more expensive using AI. Tesla makes self-driving using AI. So they're still building bigger and bigger data centers. That demand is still growing. but companies like the hyperscalers, which just turn around and rent out GPU capacity, that's starting to flatten out. So that's why it's going to be harder for NVIDIA to grow from these customers. That's why it needs to continue some demand from China. It's creating its own customers, companies like CoreWeave and other neo clouds where NVIDIA has seeded and invested in so they can build out capacity. NVIDIA is trying to move the pieces around, but its current scale, it may reach 200 billion of revenue. It's very hard to do that and continue to grow at rates that investors are going to want in order to justify a higher multiple.
There also is a question about market share, and it's been the dominant player for a long time. NVIDIA was the growth engine when it came to machine learning and all of the necessary hardware. How much are some of these hyperscalers becoming increasing competitors to them and finding ways to create good enough chips to do what they need to do?
That's exactly right. So NVIDIA is coming from a point right now where they have more than 90% share. And when you have more than 90% share in what is still a competitive market, there's only one way to go from here. So as you're pointing out, Amazon and Google use their own chips to a large extent, and they will increasingly do so. The more AI data centers are there for inference as opposed to training, the more that lends itself to them using their own chips, which they get help from Broadcom in making. So that's one place where there's going to be share erosion. And then back to China, the Chinese chip companies are getting better, and they're getting better fast. And so some of that demand, as NVIDIA is restricted, is going to be supplanted by Huawei. And so from 90% share, there's only one way to go for NVIDIA, and that's also going to be a gradual process over the next few years.
Putting some of these stories together, we've been talking about the One Big Beautiful Bill as well this morning. Do you think all the demand of energy these data centers need means maybe you will have Republicans want to keep some of those green incentives from the IRA and the Biden era? Do you think that the AI story is actually pushing some of them in Washington, D.C. to want to keep some of the grants and the credits we saw?
Well, at some point next year, based on some of these data center builders, customers, it sounds like at some point next year, we're going to hit a capacity on energy. So they really don't care where they get the energy for their data centers. They're less concerned with clean or not clean. They're just concerned with that capacity coming online, and it may not come online as fast as they would like. That's why we even started the conversation about bringing back nuclear and building small modular reactors, because they all see this the ceiling that they're going to hit at some point next year because they don't have enough energy. And the least of their concerns is whether it's clean or not. They just want more energy supply to come online by next year.
NVIDIA needs to buy Exxon or something like that. Gil, got to leave it there. Gil Lurie there of D.A. Davidson. Number one thing he's watching later, one word, one country. China. Up next on the program, Nancy Lazar of Piper Sandler on the continued strength of the U.S. consumer.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The opening bell, 60 minutes away. Equity futures on the S&P 500, positive by 0.1%. Yesterday, up 2% on the S&P 500, supercharged by some calming words from the President of the United States over the weekend, backing off on those tariff threats on the EU. The Japanese Ministry of Finance saying all the right things as well, just an indication that maybe they'll back away from long-term debt issuance. And this number, consumer confidence, which we'll talk about in just a moment, a really sharp rebound in consumer sentiment, the biggest monthly gain in some 4 years. I want to turn to the bond market because later we'll be talking about debt issuance. 5-year supply today, 7-year supply tomorrow. Yields this morning, Lisa, just about unchanged on 10s and 30s, lower at the front end of the curve.
It's especially relevant given the fact that we had that 40-year bond issuance in Japan. Everyone expected to do really well given the fact that the Ministry of Finance said, look, we got your back. Well, they didn't, and that's part of the problem that people don't understand. Every auction, particularly as the maturities get longer, becomes a risk event.
And not just the US auctions, but the Japanese much more so, maybe.
I mean, maybe actually we all need to be paying attention to Japanese bond auctions. I'll wake up early.
Lisa wants you to stay up now, overnight, and watch debt supply coming out of Japan. Yields are unchanged this morning on a 10-year. Lisa's going to do that for you. Special coverage.
You know what? ChatGPT.
Special coverage. 1 hour away from the opening bell. Let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. I, for one, can't wait for that. Anyway, on the individual stock level, GameStop supercharging its own shares, up nearly 3% this morning. In March, it announced that it would start to buy Bitcoin as a Treasury Reserve asset, something that we've seen Michael Saylor's strategy do. Well, we finally got the figure. They announced that they have purchased about 4,700 Bitcoin tokens. That totals about $513 million. So those shares moving higher off that. We also had some retail earnings over the past few hours. Macy's being one of them. Those shares up more than 3.5% after the earnings. They beat on the current quarter, saying that their strategy of shuttering stores and focusing on the really profitable ones, that is working. Now, for what it is worth, they did give a little bit more grim of an outlook, saying that they are concerned when it comes to profitability. That specifically was the thing shrunk down, saying that they will have to take some discounting given the tariff uncertainty and the unknowingness of how the consumer will be doing. Well, here's a company, a retail one, that feels more confident, and that is Abercrombie & Fitch, up a whopping 27.5%. They did something that even the best reports from retailers did that we haven't seen others do. That is raise their sales outlook. Now at the high end, they see a 6% growth, 7% growth rather. Previously, it was 5%. For what it's worth, Abercrombie & Fitch has been making a lot of moves over the past few years to reduce their China exposure. It's about 7% of the merchandise they got. About 2 years ago, it was 12%. So that also helping them in this period of uncertainty, John.
What a turnaround from that company. Danny, thanks for this morning. Appreciate it. Let's stick with the US consumer. Investors looking ahead to jobless claims tomorrow, PCE and UMich sentiment data out on Friday, following a massive jump in the Conference Board consumer confidence yesterday. Nancy Lazar of Piper Sandler joins us now for more. Nancy, it's good to see you.
Good morning.
I want to share this quote from Stephen Stanley of Santander with you. He said, the book is far from closed on tariffs, but financial markets seem ready to move past it, and these numbers suggest that households may be moving in that direction as well. Let's just think about this. Do you think there's a chance we could just move on from the volatility of the last few months without any pain or damage?
No, this tariff roller coaster is going to continue. We could have 90-day extensions for the next year as they try to negotiate deals. But it's important to remember there are three key drivers for the consumer. One is inflation. And the inflation backdrop may not be as bad as feared with these tariffs, in part because energy prices are down. In addition, second, you've got a ton of supply. Everybody pulled forward into the first quarter. And then third, it's not clear the demand's going to be that strong. And so could retailers end up having too much stuff, preventing them from actually raising prices too aggressively. And then the second major driver for the consumer is jobs. And what the Conference Board data highlighted yesterday, that the Conference Board series, particularly the present situation component, correlates with the unemployment rate. And it rose 5 points, suggesting, as claims are suggesting, that the unemployment backdrop is okay. It's not strong, i.e. the unemployment rate is ticked up. It may tick up a little bit further. But companies don't have to fire people. You ended the first quarter with strong earnings, solid revenues, productivity is strong, profit margins are strong. And so we think the weakness in the labor market is going to come from the public sector, not from the private sector. So net, the job market stays tame. And then third would be the stock market. The stock market has rallied. That's going to protect that high-end consumer. And so net 1% consumer spending. But as you go through the year, I think there could be upside in the back half.
There's a phrase you used I want to pick up on, pull forward. Is there a bill to pay further down the line, and how does it show up in the data?
Well, that's what I worry about. Near term, you could see, and you even saw it in the April data, a little bit of uptick in certain prices associated with the tariffs. As you go through the year, if the consumers aren't buying those higher ticket price items because of tariffs, these retailers could end up having too much stuff, and you could actually see deflation as you move into 2026.
There are two ways of looking at this. On one hand, you could say that people are buying all the things that they need now as they won't need them later on, and that could lead to deflation over supply. There's another way of looking at it too, which is if people are keeping their jobs and feeling really confident and the soft data is going to catch up to where the hard data is, well, people are going to absorb these prices just fine. And actually, you could see a greater inflationary kind of impulse. Which do you think is the bigger risk?
I don't think near-term inflation is the bigger risk. I think that could become in 26, if that after the first half of the year. Near-term, again, consumers did pull forward. We saw that in the retail sales data. Companies pulled forward. We saw that in the durable good orders data yesterday. Inventories are going to continue to increase given the surge we saw in imports. Consumer spending isn't going to be 2 or 3%. It's probably likely to be about 1%, which is on the softer side for the consumer. And it may be unfair to categorize everything in one bucket. It's going to be a bifurcated consumer. That higher income consumer can probably plow through some of these higher price increases. That lower end consumer is still struggling from these high price levels. You have the student loan repayments now also kicking in. You're seeing delinquency rates rise in that space. You're seeing credit scores. So I thought I was going to be able to drop the phrase bifurcated for 2025, and unfortunately not.
All I can say is reading economic data right now is like reading tarot cards, because right now it feels like you could pick out what you want and interpret it in whatever story that you wanted, and maybe it'll sound vaguely truthful for people, and they will lean into it.
I thought there was a science to it.
Tarot cards?
I thought tarot cards was like real deal.
Yeah, my son is a physicist, and he tells me economics is not a science. So
well, there we go. See, it's reading tarot cards. By the way, that's what you lean up on, is that there's a science behind tarot cards.
Just wonder if you're undermining the spiritual essence of reading tarot cards, and people might be offended.
You know, John, please go on about your deep spiritual allegiance.
I could never go into one of those places. I'm surprised how many there are around New York City.
Yeah,
you see them in the windows, like psychics
they
available.
solicit you. They grab your palm. They tell you that you're going to live a long time, and then if you say that you're not going to pay them, they say you're going to live a really short time.
So they do.
Anyway, let's move on.
All right, now you brought it up. I was just wondering.
Well, I just think that it's a very choose-your-own-adventure kind of moment. At what point do you know this data is reliable? It's not just this question of distortions.
So it's really important to pick out the data, as you just said, that are reliable. And the University of Michigan Consumer Sentiment Survey has gotten so much headlines. It's weaker than the GFC. It's back to the lows we had in 1979. It's driven by inflation more than it is by the job market, and quite frankly, it's been a very misleading indicator. You have to, what are the key soft data? The Conference Board's present situation, obviously the ISM and the NAHB. Those three tell you housing is indeed weak, which I expect it to stay weak given where mortgage rates are, house prices are. Manufacturing near term is going to be sluggish, but our work suggests you're going to see a pickup actually as you move into the back half of the year into 2026. And then the consumer, as of now, the Conference Board data suggests consumer is okay. The one area I'm excited about is capital spending. In that you have some of the soft data from the regional feds. They have a CapEx outlook component, and it actually turned up in May. We're going to get more data today on that. And so as we go in the back half of the year, I think capital spending from the onshoring theme is going to kick in. So to your question earlier, as far as will there be no pain associated with the tariffs? There'll still be pain, but we have to move towards the tax changes that are unfolding, both the continuation of the TCJA, along with the accelerated depreciation or full depreciation for manufacturing equipment and structures, and then also deregulation. So, it's a timeline. Tariffs hit us first. Now we're moving in the summer, and there's going to be more positive things unfolding, certainly about tax legislation. And as we move the back half of the year, we think we're going to start to see concrete evidence of onshoring, and there's nothing more positive for a country than CapEx.
But tariffs will continue. The cutoff date for this latest survey was May 19th, and that was really, I think, consumers starting to digest what was going on with China, but then Trump talked about a 50% tariff on the European Union. So does this conference board survey, is it just an outlier? Because then there was another big tariff hit?
I don't think so. I think the consumers, again, those three things we focus on: inflation, jobs, and the market. Those are net still positive for the consumer. I agree. If you do see a big uptick in inflation associated with tariffs, that could be a little bit of a game changer. But right now, energy is that cushion. And so this tariff roller coaster, again, it's here. We think tariffs settle in at somewhere between 10 to 15% whenever it's over, which I have no idea when it's going to be over. But it's important to look at the broader picture. And again, corporate America is healthy, and it's called a business cycle for a reason. It's companies who hire people and pay wages and build stuff. And so that first quarter earnings season was really important to see double-digit earning gains, helping explain why the job market isn't deteriorating more aggressively.
Do you think corporate America has already heard enough certainty from Washington? This is, in essence, a negotiating tactic?
Again, I'm out of my league here, but I would say yes, because God knows what's going to come out of Washington next. But at the same time, again, they're in good shape on balance. Record high profit margins, strong revenue, strong earnings. They understand now the game that's being played. I suspect they've settled on we are going to end up with tariffs, a permanent tariff of 10 to 15%, something like that. And again, because we're in good shape, they can more effectively deal with it. I worry more about some of the other countries, which is why we probably will get deals. They're not just as robust as the United States is.
There's a real sense we can handle 10%. If you go back to Liberation Day, April 2nd, that afternoon, you remember how it rolled out? People started to think we would get a 10% baseline. It would just be that, nothing else. Equities rallied for about 5 minutes and then rolled over aggressively. But when we thought it was just 10%, everybody was okay with that.
And that seems to be the status quo right now. And frankly, that's the message out of the White House. It just is unclear whether you put everything together and you get 10%, because then when you started to look at that chart, people were saying, what? And then
when he held up the board and saw the numbers were a little bit different to what we expected.
And then some White House staffers came around and were delivering these pamphlets to reporters. I looked at this, tweeted it, and then all of a sudden, market's just like tanking.
Nancy, it's good to see you.
Thank you very much.
Constructive view on the U.S. economy as we get deeper into 2025. Nancy Lazar there of Piper Sandler with an update on stories elsewhere this morning. Let's get to your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump says he's working on taking Fannie Mae and Freddie Mac public, calling them amazing companies in a post on Truth Social. Trump said the government would retain guarantees and an oversight role over both companies, which have been under government conservatorship since the 2008 financial crisis. Meanwhile, the Trump administration is raising the stakes in its ongoing battle with Harvard and other universities. Secretary of State Marco Rubio ordered U.S. embassies worldwide to stop scheduling interviews for student visas. This comes as the U.S. considers stricter vetting of applicants' social media profiles. And if you can believe it, bidding has already begun for the 2036 Summer Olympics, with one country's proposal drawing attention. Berlin formally presented its bid to host the Games, which would mark the 100th anniversary of the city's last time hosting the event. The 1936 Games are, of course, remembered for being hosted during the rise of the Nazi Party, along with American runner Jesse Owens' defiant winning performance. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the trading day. We'll look ahead to NVIDIA earnings, catch up with Ed Ludlow, who's sitting down with the CEO of NVIDIA later on today, Jensen Huang, at about 6:30 Eastern Time. And we'll speak to Megan Robson of BNP Paribas on what to look for in this market as we work our way deeper into the week. From New York City, you're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from New York City, welcome to the program. The opening bell is about 44 minutes away. Your trading diary looks like this at 2 p.m. Eastern Time. We get some Fed minutes after that. After the closing bell, NVIDIA results on Thursday, another round of jobless claims, plus some Fed speak from Barkin, Goolsby, Kugler, and a whole lot more. On Friday, going into the weekend, PCE, personal income and spending, and UMich, consumer sentiment. For now, though, all eyes on NVIDIA earnings. Due this afternoon, sitting down with the CEO of NVIDIA, the man himself, Ed Ludlow, catching up with Jensen Huang later on this evening at 6:30 Eastern Time. Ed, welcome to the program, sir. Thanks for coming in on the West Coast a little bit earlier than normal to talk about this. We caught up with an analyst earlier on this morning and said, what's the number one thing you're focused on later? And just in a word, he said China. Is it the same for you?
Yeah, it is, because there's the math side of it, right? They did a $5.5 billion write-down on this special chip for China that they can no longer sell. The write-down relates to inventory and commitments. But I think in recent days, it's been interesting to look at the terminal and see the estimates change and people catch up with themselves and try and work out what portion of NVIDIA's business China is today. That's the kind of job of those watching this program. The bigger picture is that they develop AI in China. And we know that Tencent and Baidu and Alibaba were big buyers of that H20 chip. But Jensen Huang's actually been pretty consistent in his argument that like 50% of the world's researchers looking at AI are either in China or they come from China. And right now it's a market basically closed to him. And so I think the only question is, well, has that door been opened by your recent time with the administration or not?
Ed, what's been interesting over the last several weeks is the relationship seems to have struck with the President of the United States. It feels like that Tim Cook of Apple is now out in the cold. And what we're seeing with Jensen Huang is a very close relationship, particularly playing out in the Middle East over the last month or so. What's your take on that? How is he navigating this moment? How have we seen him fill the void almost where Tim Cook was in the last few years?
Well, it's the people around the president. I know that to be true. You know, David Sachs, Sriram Krishnan, those are the two sort of top AI advisors. It also wasn't always the case, right? You know, I asked Jensen in January when we were in Las Vegas at CES, have you spoken to the president? And the answer at that time was no. He had not spoken to the president or been invited to Mar-a-Lago. I mean, right now, NVIDIA is the world's most important technology company. And, you know, the approach of the administration, I think you'll probably discuss it on this program all the time in the political context, is that it is their prized possession, the administration, to go out around the world, most recently the Gulf, and say, we can give you access to this. It's almost like, dare I say, a negotiating tool, a bargaining chip saying, we have NVIDIA. What can you give us in return? In much the same way, like, thinking as a student of history, oil used to be like that, right, in certain political discussions. Now it's the AI accelerator, believe it or not.
The man selling chips is the negotiating chip. But Ed, when it comes to the Gulf, can that fill the void of what they're losing in China?
I think what we don't have from NVIDIA is a very clear dollar value for all of those deals that were announced, right? They are multi-stage over many years. The figure that NVIDIA shared was a Blackwell figure, like X thousand over a number of years. AMD, by comparison, said, for us, this is $10 billion of revenue. And so I think that's a fair question for Jensen Huang. How much money is this worth to you, and by what deadline? But, again, more simply, size and scope. Does this make up for the opportunity or market lost in China? It would be interesting to see how he answers that one for sure.
Ed, looking forward to the questions later on. Ed Gladlow with the CEO of NVIDIA, Jensen Huang, at 6:30 Eastern Time, a Bloomberg Technology special. Look out for that a little bit later. The earnings, of course, drop after the closing bell. Lisa mentioned this a little bit earlier this morning. We've had a 44% rally off the low on this stock. Yet on the year to date, positive by almost 1%. This market has totally round-tripped. Megan Robson of BNP Paribas joins us now to talk about some of that. Megan, good morning.
Good morning.
A round trip for the likes of NVIDIA, but really for the whole of the market. What's changed? The prices might be the same, but what's changed?
I think the main driver was clearly tariffs, so some of the relief in the 90-day pause. I think that was accelerated by two other factors. So one is positioning. Positioning was very short heading into Liberation Day and throughout the sell-off, and that has started to extend and get more towards neutral. As that process happens, we think the rally will lose steam, and that's where we are now. And I think the second thing we think will change is the data. So for now, we've been in this data vacuum, not much impact from tariffs yet, but we think that will change. And as that happens, credit spreads are not pricing that in, and we think could drift wider.
There are three different prongs, particularly when it comes to fixed income. On one hand, you have this question about the fiscal overhang and just how much debt all developed markets are going to be issuing. You have a question about the economic data. That's what you're talking about with respect to this idea of us seeing the impacts of some of these tariffs. And then you have this question of whether we've just structurally changed and whether international investors aren't buying U.S. debt in the same kind of capacity. Which is the sort of sticking narrative for you that you think actually is a game changer?
I think the foreign investors is very topical right now. So foreign investors own over a quarter of the U.S. corporate bond market. So far, we have not seen selling or evidence of selling. So we follow things like overnight trading data during hours of Asia. That still suggests there's net buying. But to your point, there's two factors. The dollar is weaker, so if you're a foreign investor holding a U.S. asset, you're worse off. And then in certain places across the globe, local yields are higher, so there's other opportunities to invest. So I think it's something we're watching. So far, haven't seen selling from foreign investors quite yet.
But it goes to the question that John was asking, which is how much has changed, right? We've been on this sort of incredible volatility, and yet we aren't that far off from where we were to start the year. How much do you lean into this idea that we are at a structurally higher yield moment, driven by the fact that there are these competitive advantages with the yield market of, say, Japan for the United States, versus going back to something more familiar where economic data will drive people back to the bond market?
So I think higher yields have been a benefit so far structurally. So yields higher, treasury yields higher, credit spreads tighter. That's how things have worked so far. But we're getting close to that inflection point where higher yields can start to challenge credit. So when you have a break-even yield level of around 2.3%, where we are today, if we rise above that, that's where investors start to worry of inflation. The Fed potentially can no longer cut rates or has to be more hawkish than expected. So I think for now, higher yields has been positive, but we're at that point where it could be more of a headwind.
Megan, you said that the data so far has not reflected what's going on with tariff policy, and you're going to have this
risk for credit would be inflation. Our economists do think and are out of consensus in that there will be some staying power from tariffs on inflation. We have 0 cuts in our baseline forecast for 2025, and the market's not pricing that in yet. I think along with that, we could see the growth data slow, and from our work, that usually happens with a 1 to 2 quarter lag from when sentiment bottoms. So if we saw sentiment really weaker at the end of first quarter, we would expect to see that in next quarter earnings or in third quarter, and things like lower CapEx, EBITDA growth, inflecting negative potential.
Can we quickly finish on the most Bloomberg question ever? The boom in reverse Yankee bonds.
Yes.
What gives? What's that about?
So issuers can take advantage of lower yields in Europe. So a huge theme in credit has been, we've seen a surge in issuance of U.S. issuers going into Europe and borrowing there. You can save about 200 basis points in terms of borrowing costs. So it's been a theme, less supply in U.S. So it's another factor that has supported this rally where the technicals are just more positive for our market.
Interesting. Fun to fit that in. Thank you, Megan. Megan Robson there of BNP Paribas. You've been following the same thing.
Oh, yeah, it's a record.
Of course, there you go.
Everyone's going to Europe, not just to have vacation, but to raise money in the bond market, because also they're hitting their peaks in the indexes in the U.S. So if they want new investors, they go over to Europe, and it's getting to be a deeper market. They're very excited. I think it's a great question.
There you go. For anyone interested in the terminology, Yankee bonds, of course, companies outside of the U.S. issuing debt here in the United States, so reverse Yankee.
Maybe it's just people who want an excuse to travel to some of these regions where food is quite good.
Possibly. So I hear, going into the summer.
Maybe.
Okay. Coming up tomorrow, Bob Michael of JP Morgan, Libby Cantrell of PIMCO, Michael Zezas of Morgan Stanley, Anastasia Amoroso of iCapital, breaking down some important numbers later on this afternoon. NVIDIA reporting after the closing bell. Ed Ludlow catching up with Jensen Huang, the CEO, at 6:30 Eastern Time. Do not miss that. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board. I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Today is the day. NVIDIA after the bell. 30 minutes until the opening bell. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, we have a parade of retail results kicking off the morning, but it's all eyes on NVIDIA today after the bell. Meanwhile, in Washington, President Trump explicitly guarantees Fannie and Freddie, while a new twist develops in the Japanese takeover of U.S. Steel. Plus, Antonio Filosa takes the wheel at Stellantis, while Nissan goes hat in hand to stay on track.
All right, shall we go back to NVIDIA?
Yes, please.
I think we should. It's finally here. NVIDIA, the final Magnificent Seven stock to report earnings today, with shares up 40% since its April low, just about flat for the whole of 2025. Results clearly likely to move markets. Right now, pretty well behaved, up just 0.7% after a big day yesterday.
One of the last companies to report earnings season is almost over. This morning we got, though, plenty of retail results. Macy's topped sales expectations and maintained its outlook for the year. Dick's Sporting Goods also kept its outlook, while Abercrombie & Fitch raised its guidance.
All right, so earnings season, it's not quite over, so let's get back to NVIDIA. Shares expected to move more than 6% in either direction following its report. Earlier today, D.A. Davidson's Gil Luria says that chip export controls are the main focus.
We really don't know what the level of restrictions are on NVIDIA selling chips into China, which chips they can sell, when can they start selling them. We know that there's legislation coming to further restrict them, regulation coming to further restrict them. So we really want to hear from them, what chips can they sell into China and when can they start selling them.
And for more on NVIDIA, we are joined by Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. So Mandeep, we are used to an NVIDIA that meets and beats unbelievable results and then forecasts something that nobody can buy. Is that era over?
Not really, but I think right now the focus has shifted from hyperscalers to sovereign AI. And up until now, everyone was like, if hyperscalers are raising their CapEx, most likely NVIDIA will have a beat and raise quarter. This time around, you are fixated on China and sovereign AI demand, UAE, Middle East, how that's going to translate into demand for NVIDIA's chips, because sovereign AI is becoming a very sizable portion of NVIDIA's business. And look, I mean, somebody has to step in terms of sustaining that, 30-35% growth rate that NVIDIA needs to sustain its valuation multiple. And I think hyperscaler CapEx seems to be decelerating. I mean, they're still going to have a good year from hyperscalers in 2025. 2026, probably you will see a slowdown to 10 to 15%. So that's where the sovereign AI piece is very important.
I want to talk a little bit about production here, because you think about its new Blackwell chips, it really ran into some manufacturing issues in the fourth quarter. We know that there's heavy demand, but are they able to actually make the chips and get them out the door?
I mean, that's where the pricing power and the gross margin comes into play. If their customers are still willing to pay, the premium pricing that NVIDIA has had because the market has been undersupplied, that's a sign that, their customers are implementing these big NVIDIA systems and they're willing to pay up the price. If that comes down, and the reason why I say if is because the market has pivoted from training to inferencing. So far, it was about using the chips for training the next version of the large language models. Now it's about deploying them for ChatGPT use case. I mean, ChatGPT has 600 million weekly active users. All that is using GPU capacity, but it doesn't need the same kind of chips that were used for training. So that's where the pricing element comes in. Can an AMD or an Intel step in now that the market is moving more towards inferencing?
All right, Mandeep, great to get your perspective as we count down to NVIDIA earnings. You have fun after the bell. That is Mandeep Singh of Bloomberg Intelligence. And tonight, don't miss our Bloomberg Technology Special featuring an interview with NVIDIA CEO Jensen Huang. That's at 6:30 p.m. New York time. And of course, it's not just NVIDIA reporting earnings today. We also had retailers Macy's, Dick's, and Abercrombie & Fitch all reporting results before the bell this morning. Let's get a read on retail now with Sucharita Kodali. She is a research analyst over at Forrester Research. Great to have you with us. I want to start with Macy's, up about 4% pre-market. So it actually beat when it came to its quarterly results. This stuck out to me. It maintained its sales outlook. That's hard for any retailer to do right now, Sucharita.
Right, but at the end of the day, Macy's has been a bit challenged, and I think that the expectations have been relatively low. So that's really what we're up against. The department store sector, particularly in the mid-market sector of the retail world, has been challenged for decades now, and Macy's is by no Macy's certainly is no exception. I mean, when you look back 20 years, it had nearly 3 times as many stores. So it really is on a lower base, and they're basically essentially resetting expectations for how the business could do now.
You know, Sucharita, Romain Bostic had an interview with the CEO this morning, and he told him they're not really pulling forward their inventory build in fear of tariffs to come. Is that the right move?
Well, there is just still a lot that is uncertain about what will ultimately shake out with respect to tariffs. I think there's still very much a working hypothesis that this is all political theater, and the outcome for most retailers will probably be more modest than what some of these expectations are. I think a lot of the actions that have been taken to date are largely driven by uncertainty. So I think that what we're seeing is just the response to just not knowing more, because the risk is that if you pull forward inventory, you may just be left with things that are not on trend, and you end up discounting it later anyway. So I think that they're probably looking at other geographies where they can pull inventory from, and looking to potentially diversifying if they need to, otherwise maintaining where they need to be otherwise.
Let's talk about pricing too, because also in that interview with Romain Bostic, the CEO said that there are opportunities to be able to be sharp and to be able to continue the same pricing strategy we have today. And there are other places where there's going to be modest price increases. You take a look at what actually drove results in the latest report. It was Bloomingdale's, it was Bluemercury. These are higher end parts of the business. And I don't know, if you think about prices actually on the rise, or is it those areas where consumers are actually able to withstand some more price increases?
Well, there are different products that are going to have different elasticity levels. So certainly there are going to be things like essentials or things that are often replenishment goods, like for instance in cosmetics and beauty, where there may be an ability to price higher for sure. And then there are going to be other categories that typically tend to be in apparel, perhaps in some brands within footwear, where there may not be that ability to increase price. And I think that that's what we're going to see Macy's being laser focused on. Their merchants are really, really going to be looking at data from the past on when they had promotions, which were the categories, the sectors, the brands that they had the ability to increase their prices on, and which were the ones that were most sensitive based on pricing. So I think that that's really what we're going to see, not just at Macy's, but at virtually every retailer, whether it is Walmart or whether it is high-end luxury retailers like Gucci, that will likely do that same analysis across their entire portfolio of brands and products.
Sucharita, great to have some time with you. Hope we get you back soon. Sucharita Kodali there of Forrester Research talking to us about Macy's. Now let's get to automotive. The big executive shakeup overnight. Jeep maker Stellantis has appointed its head of Americas, Antonio Filosa, as CEO in an effort to turn the company around. His predecessor, Carlos Tavares, was forced out over slumping sales and profit. Bloomberg Autos reporter Gabriella Coppola joins us now to explain Filosa's priorities. Gabby, what do we know about, he's not a new face on the scene, but definitely to the top seat in the C-suite.
Yeah, Habemos CEO. I've been waiting for 6 months for us to finally have a CEO of Stellantis. And so I think there's a lot of relief and excitement today just that the company can move forward now by making a choice. In terms of his priorities, I mean, in the U.S., they've got to get their market share back. You know, a lot of share was lost under Tavares, especially for the key money-making Jeep and Ram brands. And they are working on that, but it's obviously been complicated by the trade war and tariffs. They have some vehicles that are made in Mexico and Canada that have some sort of the whole pricing model of how you make money off those cars has been in flux because of the tariffs. And then to look more globally, you know, Stellantis has 14 brands, and I don't think there are the sales that really justify keeping all of those brands and the jobs they support. And so one thing that Filosa is going to have to tackle is to take a really hard look at all of those brands, you know, across France, across Italy. And I think one of the things that made this job, you know, difficult to fill is that you're not just running a car company, you're sort of like, you know, acting as Geneva, or it's like running the EU or something, because you've got, you know, France owns this, you know, a significant stake in this company. So does Italy. John Elkann, the chairman, you know, the scion of the Agnelli family. Each one of those countries wants to see this company protect their auto jobs and manufacturing sector. And of course, Trump also wants to see more jobs in the U.S.
Right. Well,
so, yeah, go ahead.
Gabby, to that point, the fact that, you know, he's taking over as CEO, taking the top job at this time, there has to be a pretty hefty political element to what he has to do in the months ahead. How much time do you anticipate that he could be spending in D.C., for example?
I think that's definitely going to be part of his portfolio, but I would also point out that John Elkann, the chairman, has spent a lot of time in D.C., you know, and Paris, you know, in Turin, speaking to Giorgia Meloni in Italy, Macron in France. I mean, I think Elkann, you know, in the past, you know, he's always been involved, but you had Sergio Marchionne, who was a very hands-on CEO. You know, Tavares was very hands-on. I think Filosa will be good in that sense. He's a very personable, warm, friendly guy. He's well-liked, I think. You know, he was kind of started out as like a plant rat, as we say in the auto industry. He worked in plants in Italy and then Argentina, Brazil. So I think he could be very good in that way, too. But John Elkann is a guy who has an amazing global network of business people, politicians, contacts, and he has worked very hard to build back a relationship with President Trump. So I don't know. I think it remains to be seen, but I can't imagine that they wouldn't continue to use him and his diplomatic skills to kind of help support Filosa with all the things on his plate.
Absolutely. It's going to be fascinating to see how this develops in the months ahead. That is Bloomberg's Gabrielle Coppola reporting from Detroit. Now, coming up, President Trump says that the U.S. government will keep its implicit guarantees on Fannie Mae and Freddie Mac, even when they become public firms, which the president says he's working on. We'll bring you the details next. This is Open Interest.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Honeywell agreed to give Elliott Investment Management a seat at the boardroom table as it prepares to split into three. Elliott revealed a $5 billion stake last year and called for a breakup, blaming Honeywell's conglomerate structure for poor financial results and share performance. Elon Musk says he's not happy with President Trump's tax bill. He says it undercuts his efforts to slash government spending. He spoke in an interview with CBS.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Doge team is doing.
The legislation now advances to the Senate after it narrowly passed the House last week. Meanwhile, his Starship rocket tumbled out of control and disintegrated as it hurtled back to Earth yesterday. The stakes for SpaceX were high after the two previous flights exploded over the Gulf of Mexico, sending debris raining down from the sky and disrupting air travel. Katie?
All right, let's turn now to shares in Fannie Mae and Freddie Mac rising in the pre-market trade after a big week last week. Now, that's all after President Trump said that the U.S. government would retain guarantees on Fannie Mae and Freddie Mac when they become public firms, which he's working towards. President Trump posted on Truth Social yesterday saying that he's working on taking these, quote, amazing companies public. For more, let's break it down with Bloomberg White House reporter Josh Wingrove, who joins us now from D.C. And I want to talk about this part of his post, that the U.S. government will keep its implicit guarantees, and I will stay strong in my position on overseeing them as president. Josh, what might this all look like in practice? Because there's a lot of question marks here.
Well, that word implicit, my gosh, is carrying a lot of water.
Thank you.
Honey, can you swap the laundry out today? Yeah, you have my implicit guarantee that I will absolutely do that. So the short answer is we don't know. This has been simmering in the background. In some ways, it is not a surprise, right? Biden, on the way out, some of his staff tried to set like a game plan for how bringing these companies public would look. In other words, they kind of tried to tie Trump's hands a little bit. And since then, it's been sort of like laying in the reeds as Bill Pulte, the head of the FHFA, has sort of hinted here and there before Trump in the last week or two has really ramped up the signals now. So the interest is there, but the details just remain so unclear, including what those implicit guarantees or whatever we're going to call them would be. Because, of course, if it's not a full guarantee, it's not much of a guarantee at all. And hanging in the balance of that, of course, is the question about mortgage costs. Pardon me?
He was pretty explicit about it. I wonder if he was laughing to himself as he explicitly wrote about the implicit guarantees.
That's right. That's right. Yeah, he's dancing on both sides of that fence right now. But we're going to see. We're going to see where it goes. I think there's a clear appetite in the administration to at least pursue this. As always with Trump, he tends not to get bogged down early in the questions of, what he would consider fine print, like the guarantees. But I think that there will be corners of the Republican Party, if not the administration, that start to get nervous if bringing these companies public really does start to reflect in mortgage rates and, overall costs, which of course Trump is politically sensitive to. So I think that's the third rail here, but clearly there's interest in it. Bill Ackman and other Trump supporters have stakes here as well that are sort of looming large. And so I think the direction is clear. The path is not clear, nor is it clear whether they'll reach that destination entirely.
Josh, how does President Trump sell a Japanese takeover of U.S. steel to the American people after he and Howard Lutnick have gone on for so long about how important it is to keep these industries for national security domestically owned?
Yeah, this is certainly a reversal from his rhetoric on the campaign. There's two things I think that they'll point to. Number one, we've already seen him pointing to a $14 billion investment. Nippon Steel has not detailed that, but that's up from about 2.7, and not to be confused with the $14 billion acquisition price. So more money being pledged here. Whether that materializes or is guaranteed is really unclear right now. And the companies, as I say, have not sort of broken down the cost of where they plan to put that money. The other one is that he's talking about control, and what that looks like is also unclear, but there will be some measure of U.S. nationals on the board of the American subsidiary U.S. Steel, owned by Japan's Nippon Steel. There would be an American CEO, it looks like, as well as other sort of quasi-veto powers that seem to be coming through on this. Now, they're still working on the fine print. We are barreling towards a Friday rally in Pittsburgh. We just don't know what that'll look like, but Trump is trying to basically lock it up somehow in a way that he can claim some measure of control, even though this company will be owned by the Japanese company.
All right, Josh, thanks so much for joining us. Bloomberg senior White House reporter Josh Wingrove in Washington. Coming up, Truist Keith Lerner argues the market's risk-reward ratio is less favorable following a string of positive trade developments. We'll discuss with him next. This is Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome back to Open Interest. Barclays out with some good news for the bulls, saying that the path of least resistance for stocks is higher. Strategists saying that earnings showed resilience in a positive sign for equities, and with institutional positioning underweight, systemic dip buying means that stocks will likely trend higher from here. Let's break it all down with Truist co-CIO and Chief Market Strategist Keith Lerner. Keith, it's great to have you back with us, and I'm curious what your base case is from here. You have Barclays talking about earnings season going pretty well, about positioning right now, really leading to maybe some dip buying here, but we still have one big one after the bell, and that's NVIDIA.
Yeah, well, great to be with you. And you said it. I mean, the catalyst what we're all waiting for today, and really probably for the next few weeks, is what happens today. I think everyone's expecting a strong print from NVIDIA. They've beaten 9 times in a row, both on sales and earnings. So the key question is, how does it act? What's interesting is the stock since last June when it peaked is basically flat, 0.06%. So that'll be the key driver. I think we're in a choppier, broader range in the near term is really what we're thinking here near term, though.
Does NVIDIA, Keith, you know, in 23 and 24, they didn't just beat, like they knocked the cover off the ball and unwound the threads inside. So do they just have to meet the street's lowered expectations here, or do they have to really do something extraordinary today?
Yeah, I think expectations have come up as the stock has rebounded. Remember, it was below 100 not too long ago, so I think the expectations are somewhat higher. I do expect them to be. I guess the question is, do they break out of this range? If they break out of their trading range for the overall market, then the pain trade is higher for the overall market because tech is such an important component, and it's been in the trading range. So I think this is really going to be key, not only for today, but for the next few weeks.
All right, Keith, great to get some time with you. We are just getting started. You're sticking with us through the opening bell. That is Keith Lerner. Let's take a look at the setup as we're just minutes away from the ringing of those bells. You can see the S&P 500, it's pretty much flat, a little bit higher if you take a look at big tech and the NASDAQ 100, the Russell 2000 unchanged. But we know that yesterday was a big day in the market, a big rebound.
We were up 2% on the S&P.
I know, breaking several days of losses. And right now, if we thought we were in a wait-and-see mode yesterday, truly at this point on Wednesday morning, we are in wait-and-see for NVIDIA.
I will tell you that we're getting a red headline crossing the terminal right now. Germany has agreed on an additional 5 billion euros in fresh military aid to Ukraine. I know that Volodymyr Zelensky had been calling for at least another $30 billion, so this gets him more than a sixth of the way towards that. But once again, Germany has agreed on a fresh $5 billion in military aid to Ukraine, and we'll see if other countries follow suit.
Yeah, we'll keep an eye on that, but we'll bring you the market open up next. Don't go anywhere. This is Open Interest.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
We are moments away from the start of trading on this Wednesday, second trading day of the week because we had Monday off for Memorial Day. But Tuesday was a banger, up 2% plus on the S&P 500. And today we're going in little changed as we wait, I guess, until after the bell for NVIDIA earnings. That's really going to be the big one. I think Dan Ives said it's the most important company in the world for markets. There you see the opening bell. On the NASDAQ, you've got Qualcomm ringing the opening bell, celebrating, I think, 40 years of doing business as a company, and the stock has more than doubled in the last 5 years. It's down 30% over the last 12 months, so they can do better. You've got LTC, a REIT, ringing the bell on the NASDAQ. No one cares about that, right? But we do care about NVIDIA. Katie Greifeld is here with a look at the shares in the live trade.
Here is the setup, of course, right now. You can see NVIDIA almost perfectly flat right now, up a little bit. It did have a big day yesterday. It's the final big tech stock to report earnings. Shares are up about 40% since its lows in April. I do think it's poetic that for the whole of 2025, this stock is almost perfectly flat, Matt, for the year. So this will be a fun line to watch later today.
Yeah, just like the market today, right? Even though we've had multiple retail earnings out this morning, Macy's beat estimates, beat sales expectations at least, maintained its outlook for the year. Romaine Bostick had an interview with the CEO, which you're going to hear more from throughout the day. Dick's Sporting Goods also kept its outlook stable, and this is fairly unusual for retailers or a lot of companies this earnings season. Abercrombie & Fitch, this is a company I forget still exists. It's like reborn from the 90s, up like 600% over the last 5 years. Raised its guidance and now sees a record intraday gain. You can see the stock up 32% in the cash trade. We're back with Truist co-CIO and chief market strategist Keith Lerner. And Keith, more and more when I read not only the economic data, the hard data, but company results, I'm starting to think maybe it's not going to be as bad as we thought. Maybe tariffs aren't going to be the end of the world. Maybe we're not going to see massive inflation and every company pull its outlook. How's it looking to you?
Yeah, I think you hit it on the head there, Matt. I mean, one thing that really stood out during this earnings season, during all of this, craziness that we went through, is the resiliency of corporate America. And we have to remember, these companies have been battle tested. They've been battle tested through COVID. They've been battle tested through one of the fastest rate hike cycles we've seen in the last 30 or 40 years, and one of the highest inflation environments. So they have a lot of different levers, and they're resilient. And then the consumer has also been relatively resilient as well. So what we're seeing right now, which is notable, is the forward earning estimates for the overall market had started to trend down back in March and April. That has now stabilized, and we're starting to move, somewhat up. So I guess the message is, don't underestimate the resiliency of corporate America. They're doing it, they're doing it again.
Yeah, it is fascinating, Matt, to your point, that we didn't see that much in terms of guidance being pulled. We saw some of it. We saw some of the airlines, for example, come out with a few different scenarios about how things would go. But like you say, Keith, corporate America is battle-tested at this point. I want to talk about how Fed policy plays into all of this, because we keep hearing from Fed members and from Jerome Powell is that they're waiting for clarity, that it's really hard to make policy when we simply just don't know what's going to happen with trade policy. And I wonder, you know, when you marry together the resiliency of corporate America, of the consumer, with the uncertainty over Fed policy, where does that leave you?
No, it's a fair point. And what happens on these Fed cuts, it seems like they just keep getting pushed out. Like we were expecting in June, and now the market's expecting maybe in September. So we still think likely later this year they at least cut 1 to 2 times, because I think the inflation backdrop, outside of the one hiccup on tariffs, which is a big hiccup, like some of the trends as far as oil prices, housing prices are coming down. But there is a lot of uncertainty. But I will say overall, I don't think they're the main mover for this market, whether they cut rates or not. What you can do is you overlay the trade uncertainty index versus the S&P, and they're moving in lockstep. So I think the more important part for the market right now is this de-escalation that we've seen. Does that continue? Don't forget we have that July date coming through, and I think that will be a bigger force for the overall market than whether the Fed cuts rates 1 or 2 times, or if they just kind of sit idle in a holding pattern.
Keith, I'm going through, you have 3 bullet points in your notes to us that make total sense to me. Large caps over small caps, totally get it. Comm services and utilities, obviously. At the lows, there wasn't as much, there was more reward, I should say, than there is at the highs now. Okay, I get it. But industrials and financials, why do you like those 2 groups?
Yeah, well, and big picture, what you just said, Matt, is, at the lows, the market was pricing in a recession. We basically priced out a recession. So a lot of good news is priced in for the market as long as the good news comes through. But the risk reward is, more mixed in our view, big picture. And then to your question specifically.
That makes sense as the price rises, right, Keith? I mean, I'd rather buy low than high, too. Yeah.
Exactly. That's what we all hope to do, right? Well, with financials, I mean, they've hung in there really well. And talk about the economic resiliency, we're actually starting to see bank credit growth start to move up again. And if we get a little bit of a steeper curve, that's a positive. And that one carrot that we're all waiting for is to see a little bit more deregulation as well. And the technical trends have been positive. So we look at the fundamentals and the technicals; they're both aligned right now. And then on the industrial side, I mean, it's the strongest sector year to date, which is, if you were to come into the year and say we had all this tariff uncertainty, you wouldn't expect industrials to be one of the best sectors. But they're benefiting from a couple of secular trends. One is defense spending, right? Especially the global defense spending. Number one, a lot of that global defense spending is coming back to the U.S. And then it's also kind of a backdoor play on the AI story. You think about some of these old industrial companies, cooling systems as an example. That's a big part of the AI story as well. So I think it's benefiting from both. And so we have some defensive, we have some cyclical exposure. It's kind of not, in our view, it's not an all or nothing market. You want to have exposure to the best cyclical areas. Defensive is more utilities. Utilities are also more of a, it's a defensive play, but also an AI play as well. So it's kind of, everything's getting a bit more blurred in today's market with this AI trend.
All right, Keith, got to leave it there. Always great to talk to you. Thanks for opening these markets with us. That is truest Keith Lerner. Now, Keith said holding pattern, and that's exactly what you're going to see if you take a look at the breakdown of this market right now. The S&P 500, it's pretty much flat in the first few minutes of trading, and take a look at the split. You have 223 names moving to the upside, 274 to the downside right now. And you take a look at the moves in terms of the points contribution, what the actual percentage gain looks like. It's very small. Apple is up just a little bit. That enough in this market right now to make it the biggest contributor on a points basis. Meta, Amazon, Alphabet also rallying a little bit. You have NVIDIA shares down slightly right now. And let me emphasize slightly. Of course, all the action is going to come after the bell today. So almost an even split when you take a look at the stocks themselves. You're going to see a similar thing if you take a look at the sector look as well. Right now, if we switch up the board, you can see that we have more in the green when it comes to the sectors themselves, some of them in the red. Materials, real estate leading the way lower, communication services and tech trying to move to the upside. But Matt, let me stress again, small moves overall.
Yeah, small moves overall, and I guess we'll see if that changes throughout the day, Katie, right? Because we're waiting for NVIDIA, and that doesn't come out until the close of trading.
That's true, yeah. It's, again, a holding pattern, I would say. But, you know, news likes a sleepy market, so we'll see.
All right, we're going to continue the conversation on NVIDIA with Pierre Ferragu of New Street Research. He joins us next. This is Open Interest.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Fair Isaac is getting raised to a buy over at Baird thanks to regulatory easing. The analyst says that FICO scores have an attractive market position. Next up, we have Booz Allen getting cut to a sell over at Goldman thanks to limited growth potential. The government consulting firm announced last week that it would slash its headcounts in response to the Trump administration's move to shrink government spending. Shares down about 1%. And finally, this is a fun one. Freshpet getting downgraded over at TD Cowen. The analyst cites slowing retail sales and a risk that its refrigerated dog food concept is nearing a saturation point. Matt Miller, perhaps they're going to expand to refrigerated cat food.
Don't cats just eat whatever you put in the bowl?
No, you have to feed cats.
Oh, they're finicky. They're finicky.
They're
felines.
very finicky, but you have to make sure they get wet food because it's really important for their kidneys, in case you were wondering.
Okay, good to know.
Yeah.
I have a couple of cats, but I wish they didn't exist.
Maybe they'll get them more wet food
Let's
then.
get back to the big stock story of the day. NVIDIA will report earnings in a test for the AI trade and potentially the general direction of markets. For more, we're joined by Pierre Ferragu, Global Team Head of Technology Infrastructure at New Street Research. And Pierre, I just wonder, and I've been asking all morning, doesn't this company really have to kill it? I mean, if they just do okay, isn't that not good enough?
Or if they do okay, it's not going to be good enough. It's going to be fantastic. You know that NVIDIA is today, facing these additional restrictions, export restriction in China. So we should expect the guide for the second quarter to be actually quite difficult. You have about 1 quarter of sequential growth that is going to go away because NVIDIA cannot sell the H20 chip in China anymore. So it's going to weigh a lot on numbers. If you look at expectations today, they're probably like 2-3 billion too high for the next quarter. So the guide is going to be below expectation. It's almost certain. The good thing is that if I'm telling you that on such a relaxed tone today, it's because most investors understand that and follow that name quite closely, understand that you have like an export restriction. And of course, it's a one-off because what is NVIDIA going to do is develop a new chip, the B40, that will fit the specification of export restriction, and they will be able to sell it in China starting in June or July, and things will get back to normal.
Well, let's talk a little bit more about China because CEO Jensen Huang, he said that when being critical of U.S. policies, that he's basically going to have to cede a market that could be worth $50 billion in 2026 to Chinese rivals. So clearly, of course, Jensen Huang is frustrated here. Do you think that the situation is quite as dire as he paints, though?
Well, he's being quite factual about it. He makes about like $20-25 billion of revenues in China at the moment on a run rate basis. That's about half the opportunity. If NVIDIA had in China the market share they have elsewhere in the world, they would probably be making closer to 40 billion. So that's a reality. And then, of course, he plays his role and he's trying to have the influence he can. The U.S. administration has to walk on a thin line between, defending the interest of U.S. companies and achieving their goals of, limiting technology exports to China. It's a back and forth. It's already like the third or fourth time we have such a back and forth. The game is about the administration tightening restriction and NVIDIA creating a chip that just goes under the restrictions so that they can continue to do some business in China.
Do they walk the line when it comes to regulations all the time, Pierre? I mean, I'm always reading stories about how NVIDIA sells chips to some market in Singapore, which then those chips kind of make their way to China anyway. Doesn't the company know that this is happening, and aren't they somehow responsible for that?
No, I think it would be a very unfair claim to say that. On the contrary, NVIDIA has always been very, very proactive and collaborative with the administration on export situations. So they voice, their perspective and their view, and at the same time, they are like really 100% compliant. It is true that there can be some, suspicion that some of the chips end up in hands that were not the originally intended hands. But remember, we are talking about a business that went from being like a single-digit billion-dollar business annually to a $200 billion business this year. And it's very, very difficult to keep track of everything. But on large volumes, I would say NVIDIA is very, very tight and controlling as much as they can, where their chips end, of course. But they can't control 100% of $200 billion.
Right. And I want to talk a little bit about how the stock itself is trading. We've been making the point throughout this hour that it's pretty much flat when it comes to 2025 as a whole. It's up 40% from its April low, but it's still down from its January high. If you take a look at its valuation, it's priced right now at 29 times its projected profits over the next 12 months. Its historical 5-year average is about 40. Can we actually call NVIDIA stock cheap here, Pierre?
Well, it's always difficult, to call a stock cheap, but relative to history, you just gave the number. So yes, it is like trading at a 25% discount. So the situation today on NVIDIA stock is twofold. So there is first this uncertainty around China that makes people a bit nervous on the print tonight, of course, but it's actually a small moving factor in the stock. What really matters on NVIDIA is that the business has grown so fast and reached levels like hundreds of billions of dollars spent on GPUs that investors are putting their head around it and getting some comfort that the numbers are going to be made and actually even better in 2025. And then suddenly the concern shifts to 2026. And then investors are like worried about this growth having gone too fast, too rapidly. And then they're worried about the pullback, about a slowdown, etc. And that's what's weighing on the multiples. That's very, very usual. Now, our own perspective is that 2026 is actually shaping up now very, very well for NVIDIA. The way we look at it is going back up the supply chain. So we look at the suppliers of NVIDIA, TSMC, who supplies the CoWoS packaging capacity, and then we look at suppliers to the CoWoS manufacturing chains. And these players are already telling us that like the outlook for 2026 looks very strong. So we should see the stock work well because numbers are going to work well, but the multiple, the 29x KD you just mentioned, might continue to come down just because investors, the more NVIDIA is growing, the more investors are going to be concerned about when the slowdown comes, basically. That's like a natural derating situation for a growth stock.
Pierre, always great to have your expertise. Really appreciate you setting me straight on a regular basis. Pierre Farragut there of New Street Research. By the way, tonight, don't miss our Bloomberg Technology special featuring an interview with the CEO himself, the godfather of AI, Jensen Huang. That's at 6:30 p.m. New York time. This is Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince.
Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
It's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. The S&P right now very unchanged, and the NASDAQ 100 almost the same. So green arrows here, but not a lot of movement as the whole market, the whole world, in fact, waits for NVIDIA to come out with earnings, which doesn't happen until after the closing bell, but maybe today we'll just sit on our hands. Normally I have behind me all of the biggest stocks moving the indexes today, but what I have now is a list of the 10 stocks that BI, Bloomberg Intelligence, recommends you take a look at right now. And with that, I'm going to hand it over to Katie Greifeld and Gina Martin-Adams.
Yeah, let's talk about this all with Chief Equity Strategist over at Bloomberg Intelligence, Gina Martin-Adams, sitting to my left. So this list that you put together, it's the 10 S&P 500 companies that face the greatest risk from Donald Trump's tariffs that could come on July 9th, bearing another delay here. What stands out to me is that, you have names such as Philip Morris, you have Kimberly-Clark, Merck, Cisco, Coca-Cola. It's really covering a lot of different industries here. There's not a huge Venn diagram. So what led you to these companies in particular?
Well, they have the most factories and the most factory exposure as an overall share of their factory base. So this is specifically about companies in the S&P 500s that have factories overseas. And so we screened for overall factories. Roughly half of factories owned by S&P 500 companies are actually outside of the United States, first of all, which was kind of a stunning statistic to think how multinational. Half of factories operated by S&P 500 companies are outside of the United States.
Wow.
So that says a lot about just how much an upending of the global trade order could really impact operations of these companies. Now, of course, some of these operations are in foreign locations to service those foreign markets. I think the market is right now saying, well, those won't be impacted because this is really all about tariffs and the import prices of tariffs going higher. And obviously, that's the most profound near-term risk. But longer term, you can make a case for those factories also being somewhat vulnerable. Potential retaliations by those countries, for example, could impact operations of S&P 500 companies that are trying to do business in foreign markets to service the foreign consumer. So we're trying to take a very long-term view. This president has made it very clear that he wants to change the dynamics of global trade. That means that even after 90 days, we can't rest on our laurels and anticipate that it's all over. We're just going to sit at 10% forever. I do think that he's going to continually come back to this well over the course of the next 4 years to change prospects. So that's why we created the list.
So which of these companies do you think is most at risk or most needs to bring production back to the U.S.? And are any of them actively doing that now?
Yeah, I think that many of them actually started in the first Trump administration to try to address supply chain risks, but not necessarily in the form of bringing the companies, the facilities back to the United States.
They moved it from China to Indonesia, China to Vietnam,
building
China to India.
You know, the biggest headline example in the S&P 500 is, of course, Apple, which isn't on our list, interestingly. But nonetheless, Apple gets the most attention as a target for President Trump right now because they did move their operations or move a great deal of their facilities from China to India to try to account for. Why is it not on your list?
So widely held?
Yeah, because it's not actually of the most exposed. It is widely held, but it doesn't have as many factories or as high a share of factories overseas as some of these other companies. I would really hesitate to target one specific company because I think in today's day and age, we have to be aware that the president is going to target the companies that he chooses to target. And I'm not sure that we have a playbook for why or how or what he will target. But what I will say is across industries, you've got something like 65% of industries in the S&P 500 with profound levels of factory exposure outside the United States. It spans consumer staples to materials to industrials to technology. Big cap tech is just one of the stories. Broadly, technology is exposed to this as well. So it is going to be a potential long-term driver of volatility for the index.
All right, Gina, really interesting list. Great to get some time with you. That is Bloomberg, Gina Martin-Adams of Bloomberg Intelligence. Interesting, again, Apple's not on the Bloomberg Intelligence list, but we know it's on President Trump's list.
Yeah, absolutely. And that relationship, Tim Cook and Donald Trump, is going to be important for so many investors. Coming up in the next hour, Ilana Weinstein joins us on hedge fund talent wars. Plus, Elanco's Jeff Simmons talks about the pet care industry, more cat talk. And Acrissure's CEO walks us through his company's billion-dollar deal with Heartland Payroll Solutions.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The Trump administration is targeting higher education by pausing all overseas interviews for potential student visa holders and expanding social media vetting for foreign exchange students. Correspondent Nancy Cordes.
As you can imagine, that's pretty labor intensive to go through the social media of every single person who applies for a student visa every year. So are they going to get more resources to do that? And exactly how soon would that happen? And will it be in time to enable everyone who's been accepted at a U.S. university for the fall to actually get their visas and get here to the United States?
Breaking news from the Middle East. Prime Minister Benjamin Netanyahu's just announced Israel killed senior Hamas leader Mohammed Sinwar in a recent airstrike in Gaza. He is or was the brother of Yahya Sinwar, a mastermind of the October 7th attack, who was killed by Israeli forces last year. Mohammed Sinwar, believed to have succeeded Yahya as the leader of Hamas in Gaza. A 74-year-old doctor in France will likely spend the rest of his life in prison for sexually assaulting dozens of children while they were unconscious or sedated.
The former surgeon was sentenced to 20 years in prison, the maximum sentence for rape. Joël Le Scournac had admitted he had abused or raped 111 of the 299 alleged victims. In March, he stunned the court when, unsolicited, he admitted he had also abused his granddaughter. Earlier today, in his final words to the court, Scournac said he expected no leniency. Elaine Cobb, CBS News, Paris.
Update on a suspected drugged driver in the UK arrested on suspicion of attempted murder.
I'm Vicky Barker in London. Liverpool police continue to question the suspected driver of the van that plowed into pedestrians attending their soccer team's Premier League victory parade Monday evening. They have until tomorrow to file charges or release him. They now say 79 people were injured, 7 remain hospitalized.
A day after President Trump called the daughter of TV reality stars Todd and Julie Chrisley to let her know he'd pardoned her mother and father.
Congratulate your parents, and I hear they're terrific people. This should not have happened.
They could walk out of prison. They were convicted of evading taxes and fraud. Sean Combs' sex trafficking trial resuming a day after his former assistant, Capricorn Clark, testified she was kidnapped. CBS's Katrina Kaufman.
Over the course of 5 days, she was brought to a dilapidated building and subjected to lie detector tests. The man there, she said, told her that if things didn't get figured out, she would end up in the East River.
The Dow is up 10 points in early trading. This is CBS News. A lot of recent college grads are having a tough time finding work.
Global economic advisory firm Oxford Economics reports newly graduated job seekers, only about 5% of the U.S. labor force, have a higher unemployment rate than the national average. It's the first time this has happened in the last 45 years. So why are recent college grads having a tougher time than previous grads? The report points to an oversupply of them in fields where business demand has waned, especially in the tech industry. Michael Toscano, CBS News.
New Yorkers are getting ready to peer between the buildings tonight for Manhattanhenge. Every year at the end of May and again in the middle of July, people flood the streets for a breathtaking view of the top half of the sun, aligning with the city grid as it sets in the west. It's supposed to reach its fullest effect at 8:13 p.m. Eastern, but bummer, the forecast calls for clouds and rain. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're also streaming live on YouTube, so check us out there. Coming up today, we'll start off strong. Gina Martin Adams, Bloomberg Intelligence. She's a U.S. equity strategist there. What do we do with this market? We've retraced a lot of the sell-off. Where do we go from here? Mira Pandit, Executive Director, Global Market Strategist at JP Morgan Asset Management. What are they telling their clients these days about where the opportunities are in the market? Steve Mann's going to join us, Bloomberg Intelligence. He covers the global auto industry. We're talking about Stellantis. I got some new management there, and I want to just get a sense of where we are with this EV transition and what does it mean given the tariffs that are affecting so many industries out there. Sam Fazeli covers all the pharmaceuticals for us, and he manages our European research operation. He's in New York today, so we'll get him in our studio, and we'll talk all things healthcare. But right now, let's go to John Tucker and get a Bloomberg Business Flash.
All right, guys, and this Bloomberg Business Flash being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest. Learn more at ibkr.com/RIA. Right now, the major averages, little change in the early going. Among the most active, NVIDIA ahead of the earnings report after the close. And we're going to be speaking with CEO Jensen Huang. That's at 6:30 p.m. Wall Street time on Bloomberg Radio, TV, and the Bloomberg podcast page on YouTube. Right now, the S&P 500 down just about 3 points at 59.18 on the index. The Dow Jones Industrial Average 15 points lower. The NASDAQ 100 right now is up 2 points. We'll call that unchanged. A best performing stock in the S&P 500, Fair Isaac Corporation. The initials spell FICO, the people behind your credit score. Christian Nolting at Deutsche Bank says stocks will push higher, but it's not going to be a smooth ride.
I think it's probably
a bumpy road ahead, but if you look for 12 months, we do still see another 5-6% on gains, for example, on the S&P 500, but it will come with some volatility.
And President Trump continuing to push to take Fannie Mae and Freddie Mac public. A social media post last night under his name read, "I am working on taking these amazing companies public." Now put on your thinking caps. He's going to take them public, but they already trade. Fannie Mae shares up right now 7.2%. Explain that to me.
Because doesn't the government own the boatload of the shares?
The common shares still trade. They essentially don't have any value because of the overhang of the Treasury's senior stake. They remain public in the sense that the shares trade. They make SEC filings, but they're essentially 99% owned by the federal government. So maybe that explains it.
So they go public and then, but it's still backstopped. Sure. Okay. Makes sense. Yep. Yeah. Doesn't make sense. All right, JT, thanks very much. You good?
You're quite welcome.
You got it. All right. Alex Steele alongside Paul Sweeney. We're going to take a look at some of the stocks on the move today. We're joined now by Bloomberg's Lisa Mateo. Lisa, taking a look at Macy's.
Yeah, okay, so we'll start with retail. So the way people shop is changing, right? You go to Amazon to get a lot of stuff online. You know, the boxes show up at your door. People get luxury stuff online. So Macy's had to change their approach. So what they did is they had the strategy to focus on those best performing locations. So they boosted the staff there. They improved the look of it, their product displays, and it looked like it was working. Posted better than expected quarterly results. Comparable sales stores fell less than expected. They did rise at Bloomingdale's and Bluemercury. Those are those higher end chains of Macy's. Revenue topped estimates. And then you do the look ahead. So they maintained their sales outlook for the current year. But here's the thing, it did cut its full year earnings guidance to account for tariffs, and that has had shares lower, down as much as about 3% after they opened. So how they plan to kind of weather this uncertainty, they say that since they have this good mix of off-price, like the cheaper merchandise, and the more expensive luxury merchandise, that's going to give it that flexibility to help them weather the storm.
All that means, though, that less sales, which I don't appreciate. Yeah. So when Macy's reports good numbers and their inventory is looking good, I get bummed at the end of the day. Yes. Abercrombie & Fitch also delivering super solid numbers.
Yeah, they did. Their shares have been up more than 25% after the open, so they've really been on the rise. So the basic specifics, they upped their full year outlook. They see net sales growth of 3 to 6%, included about $50 million of tariff expenses, too. They've been reducing their exposure to China in recent years. Vietnam is their top vendor, followed by Cambodia, India. What really helped is actually the Hollister brand. Comparable sales there were up 23%, so that really blew past expectations. And they say they have this fashion mix, so they have, you know, men's, women's, jeans, dresses, athleisure wear, swimsuits. They have a whole bunch of different things, and they have the broader audience. So I don't know, Alex, maybe you can relate. I went with my daughter, and she said I was needing an update on my jeans because skinny jeans are out, Mom. And so I had to update the jeans. And so wound up getting for me and for her. So that's that broader kind of audience.
Yeah, and you know what? You hold on to those skinny jeans because you know what? In a couple of years, they're going to come right back. So don't you worry about that.
Bell bottoms.
Bell bottom. No. There's wide leg. There's bell bottoms. Those are different.
Okay.
Just putting it out there.
The jeans lesson.
Vail
Yes,
Resorts.
Vail. Okay, so skiing. Yes, shares have been up really as much as about 14%. It really had a tough winter. What didn't help too, they had that ski patrol strike in Park City, Utah. Yep. That really affected them. Ski visits were down 3.1%. So they needed this change in what they're doing. They're bringing back their former chief executive, Rob Katz. He's going to lead the company. He was CEO back in 2006, so he's going to replace Kirsten Lynch, who stepped down. She was there since 2021. But it's kind of like look at the trend of CEOs coming back, right? Bob Iger coming back to Disney, Starbucks reinstating Howard Schultz, back in 2022. So it's that trend going on.
Back bowls at Vail.
Yeah.
That's what we're talking about.
You've been.
Oh, yeah.
But here's my thing. If you have to manufacture snow, doesn't that wind up costing money and hurting margins, or is it?
Yeah. But out west, you don't have to do it nearly as much.
Oh, okay.
But they'll do it in the lower, just so they can start their season earlier. They'll do it on lower elevations.
Oh, I see.
In the east, if you don't have man-made snow, you don't have snow. No. But out there, they get 300 inches of snow a year.
Oh, okay. So that's not a problem for.
Yeah, it was a good snow year.
All right. Yeah. Thanks so much, Lisa. Really appreciate it. Don't worry. You stick to those skinny jeans. For more conversations like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere that you listen. So NVIDIA's reporting. I hear it's a big deal.
I hear.
I say that, but really, is it? I mean, the options market's pricing in like a 6% move versus 8+ is usually what we wind up getting. So maybe the market's digesting it in a little bit of a different way. Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist, joins us now. What did we learn from, say, the hyperscalers and other big tech names that we can glean towards what we can expect from NVIDIA?
Yeah, I think what we learned is expectations were low, but NVIDIA is always last, and so that's very difficult to determine if expectations have been reset or not. But I do think expectations are still somewhat low, with the exception of some of the changes that happened with policy, which really elevated expectations specifically for NVIDIA's sales of semiconductors into the global economy. I do think the biggest thing to watch, though, is still margins. It's really about margins within tech. It's about, will these companies continue to be able to command higher levels of price in an environment where competition is escalating pretty severely globally? And can they keep those margins going forward? You know, I think in terms of the impact on the market, it's also important, but peak NVIDIA impact was actually in the first half of 2024. So we've already seen somewhat waning impact of the stock on the broader equity market, because that was peak earnings growth, that was peak optimism, that was peak price performance as a relative to the S&P. So it's still important. I think in terms of the data and the details, everyone will be asking not only about margin, but also how NVIDIA is going to either benefit or not benefit from the Trump administration policies. So that's what we'll be looking for. But there's definitely a lot to watch here. The stock is still one of the largest in the index. It's still a very strong driver of sentiment across many, many themes in the tech space. And so I think there's a lot to absorb in tonight's release.
What's the... does anybody have any conviction out there, Gina? Because, I mean, if you're a bear or you just don't feel that great about things, you say, boy, the market sold off 20% so fast. But then we retraced much of that on the way back up, and all of that in a very short period of time. To me, that would just take away any conviction I have to where we're going next year. What are you hearing out there?
I think investors are grappling with a few things. I think that they can't avoid the trend. Certainly can't be caught off guard when stocks are rising. You have to be exposed. So many investors have sort of held on through the downdraft, but if they didn't, they jumped right back in once the stock market started recovering. There's some frustration that the fundamentals just don't matter, and I think that that's natural in such a whipsaw price action kind of environment. You get to a point where it's just, you know, on a day-to-day basis, the market is kind of living under President Trump's thumb, and that's frustrating for a lot of people. So I think the investor base would certainly sympathize with your statements. I think eventually we get past the 90-day pause and we sort of have to reckon with the idea that, okay, maybe, hopefully we're in some sort of more stable environment and we can kind of reassess the long-term implications of a readjusted trade order. But there still is some uncertainty out there. And I think the fundamental investor gets this. The trader is just really happy to move along with momentum.
But here's what I wonder. Have we seen what the worst case scenario is? So now we can actually price that out more meaningfully. And in the case of, say, retail, I wonder if there's actually more upside. If President Trump says, like, look, we don't want to build sneakers and T-shirts in the U.S. We want to build things like chips and factories and stuff.
Sure.
You would think that, okay, maybe there'll be different exemptions for different sectors.
Sure. I think that this is the problem, though. You had a lot of what if that happens, will that happen, if it's not certainty. And that is not investable. The what if is not investable, right? And that's, I think, what's really difficult for the fundamental trader is they can't invest in the hope that there will be a change, right? What we can invest in is real-time data changes, real-time data sort of signals. And from the market signaling effect anyway, it has gotten better from a technical perspective, but there's no net improvement in the stability of the data nor the trend of the data yet. Will we get there? Possibly. I think there's also an excessive attribution to fundamentals being driven by Trump that is frustrating for the investor community, because while we're all sitting here reading the headlines, right, there was a world that was pre-trade that was giving us some signals of deteriorating economic growth even prior to the trade announcements, and those signals have not improved after this whipsaw of trade. I think that the other thing to consider is what you're suggesting is what is increasingly priced in.
Yep.
What you're suggesting is we're going to keep backpedaling. That's what the market is pricing now. And we'll probably continue to price that until proven otherwise.
Until we get more. Any kind of clarity. All right, Gina, thank you so much for joining us. Gina Martin-Adams, Chief Equity Strategist, Bloomberg Intelligence, joining us live here on our Bloomberg Interactive Broker Studio. Coming up, Mira Pendit, Executive Director, Global Market Strategist at JP Morgan Asset Management, to get her thoughts on these markets. S&P 500 down 7 points. Oh, my goodness. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News with this Bloomberg Business Flash, being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Right now, ahead of NVIDIA's earnings after the close, the major stock averages little change at this point. You have only 3 of the 11 major industry groups in the S&P 500 pushing higher. Healthcare and communication services, they were in the lead. The utilities, the worst performing group. S&P 500, 8 points lower. That's down about 0.1%. The Dow Jones Industrial Average down just 37 points. NASDAQ 100 right now, that is down 20 points. The 30-year bond, $4.99. Today it's up 4 basis points. Among the earnings reports, Macy's posting better than expected quarterly results. They also anticipate what they call modest price increases. And shares of Macy's right now, they are little changed. Uh-oh. The value of the American Dream Mega Mall and Entertainment Complex in New Jersey Meadowlands plummeted by $800 million. This is a blow to municipal bondholders.
Wait, is this the one that has like the thing that I've never been to?
It has the big, what do you call it, Ferris wheel.
Got the indoor skiing.
Who wants a Ferris wheel in a swamp?
The thing.
But I mean, maybe that's part of the problem in New Jersey.
But this feels
wow,
like a
look
place
at the swamp.
I would definitely want to go.
So municipal bondholders, they have a lot of the debt. It's backed by payments in lieu of property taxes.
You need Joe my second.
3.5 million square foot venue. Everybody wants to go in my immediate circle, but I refuse because Johnny don't do malls. Anyway, we check the
But
markets.
would you go on the Ferris wheel while everyone else did
to
the
see
mall?
the swamp?
Mm-hmm.
Maybe.
Okay.
Because I
see?
like swamps.
There we go.
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, JT, thanks a lot. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from our Interactive Broker studio right here in Midtown Manhattan.
Speaking of swamps, the Great Swamp National Park or State Park in New Jersey is awesome.
That is
It's
very pretty,
beautiful.
actually.
And if you catch a nice weather day, it's just water. You wouldn't expect it in New Jersey. But I've taken like 1 million Cub Scouts and Boy Scouts trips there.
But is it an actual swamp?
Yes, but it's actually very cool and easy
There's
to
a lot
get
of
around.
wildlife and stuff like that.
That's awesome.
It's
I
not
love
like,
that.
In New Jersey.
Cars.
Go figure.
No, I love
used
that.
old
So maybe you
cars
would
and
go
old-
on the Ferris wheel.
But that's a different
So
swamp.
don't,
Yeah, this is
okay,
this is
sorry.
the nice swamp.
Well, I see you one swamp, you've seen it all. All right, let's get back to the market here. Total wait and see when it comes to, say, NVIDIA earnings. Let's start there with Mira Pandit, Executive Director, Global Market Strategist at JP Morgan Asset Management. We can take NVIDIA in stride, but I wonder what we're going to learn about the U.S. exceptionalism trade/theme once NVIDIA comes out.
It does feel like markets are getting a little bit over their head, a little bit beyond their skis here. If you think about Friday's sell-off with some of the tariff announcements of about a 0.7% relative to the reaction when things reversed out by Monday when markets were up, Tuesday when markets were up 2%, it does feel like we are overweighting the good news over the bad news. And while the high water mark for volatility from April is probably in, there are still a number of catalysts that could push markets downward. If we think about earnings at 9% expectations right now, looking pretty unrealistic. The fact that valuations are almost back to where they started the year, or the fact that we've seen to find a new home at around 4.5% on the 10-year Treasury yield, all of these things could start to weigh on markets over time.
So, Mira, one of the underpinnings of this market has to be earnings, and we saw a lot of companies pull their earnings guidance, and earnings have come down. I guess the question is, have they come down enough? Do you still think there's earnings risk in this market?
If we're going to see potentially slow growth this year, recession is no longer our base case, but even slow growth, it's going to be very difficult to achieve what some of the analysts expect in terms of profit growth. So it is still a risk. And although we had an incredibly robust first quarter where we had essentially 7 percentage points higher on year-over-year growth than we would have expected coming into earnings season, that is reflective of the situation we were in, not the situation we may be in. And when we think about tariffs in particular, although the tariff rate has potentially come down quite a bit, we're not out of the woods, and it's still going to be a lot higher than it was last year. So that means domestically and from foreign sources, revenue could slow. And when we think about margins, someone's going to pay for those higher prices. Partially, it could be the consumer. Partially, it could be companies that are therefore compressing margins. So we do have to be mindful of that. In light of tonight's earnings releases, I would also highlight prior to this final Mag 7 reporting, we have seen upward earnings revisions in terms of expectations to the Mag 7 with the reporters so far, relative to downward revisions for the rest of the index. So Is it going to continue to be profits, exceptionalism of the Mag 7? That is our big question for the year around profits.
Absolutely, which then also brings us to other assets in terms of, say, the long end of the bond market and the dollar as well. What are we going to learn about those assets after the NVIDIA earnings?
It looks like from a treasury market perspective, and when we think about rates, we've somewhat found this resistance level at 4.5% on the 10-year and perhaps around 5% further out on the curve. Even though the risks are still skewed to the upside when it comes to yields, we have less of that downside pressure from potential slowing growth. Although inflation hasn't really caused much of the uptick in yields so far this year, it is still that term premium question mark, which has nothing to do with profits and what specific U.S. companies are doing, and everything to do with debt, deficits, who's buying up bonds, and whether they're more price sensitive than perhaps they were in the past when the Fed was a big buyer. Some of these weak auctions continue to push up bond yields as well. So overall, that environment of rising term premium skews risks to the upside. But the question mark is, when we think about what's priced in the bond market, is a lot of this risk already priced in, and we're finding some of that ceiling from a yield perspective. I mean, despite a lot of the episodes of rising yields we've seen so far this year, most areas of the bond market, with the exception of areas like the 30-year or municipals, are actually positive this year. So we tend to lose sight of that.
Are you taking credit risk in this market, Mira?
Credit risk is actually not a bad place to be because you are getting good yield in credit, but you're also sort of recession-proofing a little bit. I mean, if we don't have a recession and we just have slow growth, you are going to be able to get access to company balance sheets, to company profits, without taking on that same risk of the equity market. Of course, if we do head to recession, we could start to see a little bit more choppiness there. But overall, right now, it seems like a nice balance between equity market risk, but being overly conservative in the bond market because you're getting that income and that access to the health thus far of companies.
All right, Mira, thank you so much for joining us. Really appreciate it. Mira Pandit, Executive Director, Global Market Strategist at J.P. Morgan Asset Management. Let's turn to the auto business. Stellantis was in the news today. Looks like they're getting a new CEO. The guy who's running the Americas is going to go over and run the whole shebang here. Steve Mann joins us here. He's a Bloomberg Intelligence Global Autos Analyst. We never talk about Stellantis. Can you remind us who Stellantis is?
Well, Stellantis is an amalgamation of a number of brands, European and U.S., but mostly best known for owning Jeep and Ram trucks.
The old Chrysler.
Old Chrysler, that's right.
And Fiat, right?
Fiat, that's it.
Okay, and that's kind of and they came up with Stellantis. Okay, they got a new CEO.
Yeah.
What happened to the old CEO, and what do we know about the new guy?
Well, the old CEO resigned.
Okay.
Part of it is because, earnings were pretty bad. And it may not be 100% his fault. The auto market was weakening. So we have a new CEO. Based on what we're seeing with the stock price, I don't think the market is too thrilled about it. He does have a lot of experience in the auto industry. He's been with Stellantis since 1999. So it's been a while. Like you said, the last stint he was in managing the North American business for a few months. And prior to that, he was at Jeep. But, it took a number of months for them to identify someone new. But I think the market is just pretty surprised that they went with somebody internal and not somebody external.
So what do we learn about that? Because so many of the problems that are hitting car makers are in some ways completely out of their control.
Yes.
In terms of trade, supply chains, sort of the war on EVs here in the U.S., right? So do we learn that, hey, we don't think it's very fixable, so we're not going to worry about someone from the outside? Or is it look, the U.S. is in turmoil, we need someone who knows that market? What do we learn?
So there's, they do have issues that's not in their control, but there's a lot of issues that they are in control. So, quality is an issue. I think a lot of American buyers thinks Jeep has kind of fallen off in the quality side. And interestingly, the new CEO, Antonio, actually managed Jeep for about 2 years. So, I think, investor will take that as probably a negative. And then the other issues is morale. Over the past few years, sales have been weakening. They've been closing a lot of plants as a result. Dealers are not very happy with some pricing issues since COVID. So there's a lot of issues that, you know, the new CEO will have to kind of address, and hopefully he can turn that around.
All right, so for the big three U.S. automakers in general, what is the consensus on tariffs and how much it will impact their business?
Well, interestingly, Trump has been giving a lot of reprieves and reliefs to you know, various countries and regions and certain sector, but he hasn't really done much for the auto industry. There was some relief, a 2-year relief, but I think he's, you know, going full ahead with these auto tariffs, and a lot of companies still don't know where the impact, how big the impact is. GM actually announced they're going to be a $4 to $5 billion impact this year.
Wow.
Toyota said, you know, over between May and March and April, the impact was 1.3 to 1.5 billion. So given these numbers, it's going to be huge.
What about EVs? Is it possible that EVs in the U.S. go the way that EVs went 100 years ago?
It could. It could.
Like that's not immaterial anymore.
I think, you know, there's a number of issues that's facing the EV market. Infrastructure is a big one. It's just not as convenient as people would like it to be. The other thing is the cost. You know, I still think that, you know, EV has a place in the marketplace. It's not going to be 50% market share by 2030. We think it's more like half of that, 20 to 25%. And then look, there is a risk to a lower number because of the tariffs and affordability. Some of these EVs are actually made in Mexico. So if you slap on tariffs, that makes it less affordable for consumers.
It's just amazing how fast that part of the industry has turned around.
It turned negative. I mean,
that's what I'm saying.
Yes.
Like that, like just went from like, yep, we're going this direction. The pace is TBD, and now it's like, will this actually survive? All right, great to see you, Steve. Thanks very much. Steve Mann, Bloomberg Intelligence, Global Autos Industrials Research Manager. On the flip side, though, it's all about hybrids now, and like all the new cars coming out and the new innovation is going to the hybrid kind of model.
Yeah, I mean, we leased a hybrid for the Offspring, primarily because he spends his time in California. Gas prices are really high there.
It could get worse.
And it could get worse. So it made sense for us. But there wasn't a premium on it to speak of versus the internal combustion. So I said, okay, they convinced me.
Right, because the hybrid form.
Yeah.
So it doesn't have to just be just in that battery. All right, coming up, Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals. We just love talking to him every week. What is up next in the biotech space? What do we need to watch as consumers, people, and as investors? This is Bloomberg Intelligence.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. Investors right now seem to be waiting on the sidelines. Volumes lower for this time of day on average. Major stock averages, little change. Not a lot of oomph here. S&P 500, 12 points lower. That's down 0.2%. The Dow down 88 points, and the NASDAQ 100 right now 27 points lower. That's down about 0.1%. Stephanie Gould at Robinhood Financial says interest rates should be the guide for your investment choices.
You're seeing interest rates that it's very hard to get them lower and more likely to see them higher from here. So I think with that, you just want to be sure that you're investing in stocks that are not as expensive and you're really looking at valuations.
Right now, the long bond up 4 basis points, 4.99 for the 30-year. And just as we get ready to hear from NVIDIA after the close, by the way, those shares a little changed right now, down about 0.1%. DeepSeek is saying it's upgraded its R1 artificial intelligence model, which of course helped the Chinese startup gain global prominence earlier this year. And here's one for you. YouTube is now the TV service of choice for viewers of all ages.
Not even close. Not even close.
People in the U.S. spend more time watching YouTube on a TV than on a phone or computer. This according to the company. Now, not including YouTube TV, the service accounted for over 12% of TV viewing in April, more than all of Walt Disney's TV networks and streaming services combined, and that's according to Nielsen.
That's amazing.
Craig Moffat of MoffettNathanson and Michael Nathanson said it could be worth $700 to $900 billion if it were spun out today.
Wow. And the key demographic, over 40% of the viewers are ages 18 to 49. So that's pretty key.
For advertisers.
For advertisers.
There you go. John knows his business.
That's a huge, I'm like stunned.
Somebody is actually watching you right now.
Yes.
Hey,
and
Mom.
their kids.
No, I'm kidding. Mom doesn't know how to get on YouTube. All right, JT, thanks a lot. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. You can check us out at Bloomberg.com, YouTube. Thank you for watching. And also on Roku and all your smart TVs. Check us out on our Originals platform. Always a treat. Sam Fazeli, Bloomberg Intelligence Director of Research and Senior Pharmaceutical Analyst in studio. One of our favorites. Love chatting with you. And we love talking to you just like, hey, what are you watching? Because there's so many cool drugs, so many cool things that are happening in the space that can totally change the world and save lives. What's front and foremost in your mind?
Let me return the compliment first. You know I love being here. And I love talking to you guys. I love your show and everything.
Is there a budget?
Enough of the love.
He only comes here when he's got a conference to go to. Yeah. He never says, oh, gee, I'm going to go to New York and see Alex.
But as we learned, the conferences are hardworking on the weekends.
Yes.
None of this golfing stuff that Paul does.
Golf?
Yep.
Yeah.
So what am I watching? Vaccines a little bit. Of course, we have the cancer conference coming up, but let's talk about vaccines a little bit. There's some changes that are happening quietly in the background or loudly, depending on how close you are to the story. And that is that normally decisions about who should get a vaccine and when and at what age, etc., is done through consultation with a group called the Advisory Committee for Immunization Practices, ACIP. That's part of an advisory group that meets and talks and comes up with ideas and gives guidance to the CDC, Centers for Disease Control. That seems to have been quietly put aside. Not that the ACIP has been disbanded or anything, but we've just had decisions made for who should not get or should not be necessarily licensed for the vaccines to get the COVID vaccine. Pregnant women no longer licensed for, children no longer licensed for. Not a massive surprise, because there was already something from the head of the FDA and the head of the biologics division of the FDA, CBER, to that point, essentially. But it's interesting that they're making the decisions rather than going to their advisory group, say, look, what do you guys think? Who are vaccinologists? Here, there are people who are not vaccinologists, who are not infectious disease experts, making these decisions for you, the American public.
What's going on in the rest of the world with just vaccines in general, flu vaccines, COVID vaccines, whatever?
No, so look, it's been the same for the past many years, right? The vaccines are licensed. There is then government decision as to who should get it. But I, for instance, do not qualify for getting the shingles vaccine. But I went and got it because it's still approved.
Right.
That's the part that's getting a bit complicated here in the US now. If you had a pregnant sister or whatever who wanted to get the vaccine, now it's going to be risky for the physicians to give it to them because they're not licensed for anymore. They will be off-label. In Europe, they are licensed. The physicians can give them. It's just who gets reimbursed. Who is it paid for? I went and paid out of pocket. I didn't want shingles, right? I didn't want to wait till I'm 70. I mean, that's years away, right?
Shingles, it's not good.
No, it's not good. So that's what's
So
happening.
basically, here in the U.S., we can still get it if we choose to. Like, I can get it for my daughter, but I probably have to pay out of pocket for it.
Probably have to pay out of pocket for it and also convince a physician to prescribe it. It's funny to see how it all evolves. There was another advisory committee that is an FDA group that talks about what variants should be used in the coming year. They were asking the FDA folks on that conversation, do you think if we change the variant, there will have to be a full-blown trial? The FDA folks said, well, we don't actually know the answer to that yet. So we are in a state of flux. And that is not going to end up being a good thing because it's going to continue to undermine belief in vaccines, which is already quite weak. And I don't think that's good for the health of the population. And it's not good for the companies either.
Well, that's what I was going to say, too. Like, what do we do? Like, for Paul and I, who don't live in Europe, we got to figure this stuff out.
Come over.
Like, what are we
I'll
supposed
open
to
a
do?
bottle. Give you a jab.
He keeps saying this, and it never actually happens, Paul.
So I don't know. I just get the flu shot every year because I've just been conditioned to it, and they do it right here in the building, so it's easy. I did not get COVID this year.
You didn't.
Shot. Just because
Neither did I, just to be clear, right?
Yeah, but
I mean, I did because COVID loves me hard.
Right. No, but so there you go. You see, but you're not in the demographic that I don't think demographic applies to you. You're not 65. 100% sure of that.
100% sure. Thank you.
And you are not. You don't have a comorbidity.
No.
But if you had suffered from long COVID or difficult reaction to COVID, it's tough. Now, of course, we have our much more positive, if you could say that about a cancer conference coming up. And the reason I say positive is because I don't think there's a year that goes by that we don't see a quantum change in treatment for a particular subtype of cancer. And this year it continues to be bladder cancer. I think we're seeing some meaningful advances in new treatments for even lung cancer that we thought we didn't. And, there's new ideas that are coming along. So it's going to be a very exciting conference.
So doctors and researchers, they give talks about what they're doing on the science side of it?
Researchers, companies, doctors, basic scientists, they all come and show their data, discuss their data. Lots of Chinese input because the Chinese science has gone from strength to strength. And we all look at it and decide how it changes the competitive environment for our companies.
What about, though, the risks of federal funding being cut to universities that do have strong science centers? Does that filter through in a negative way to the innovation that we have with different drugs?
No doubt about it. There is, if you had an NIH budget of $47 billion and it's taken $20 billion out of it, someone's going to suffer. Now, it may not be cancer necessarily, but possibly cancer too, but infectious diseases, studies of long COVID, they've all been cut. So, and then there's the National Science Foundation whose budget's been cut. Look, I think the government's making a decision. I don't have enough money because I have this massive ballooning debt. I want to control that. I want to create lower taxes for people. I have to cut the money from somewhere. So, unfortunately, it's coming out of, some of it's coming out of these budgets.
And this is in Chicago, this conference?
The conference is in Chicago.
There's good restaurants in Chicago.
Oh, man, tell me about it.
Okay.
Looking forward to it.
you do
So you're not
do
going to go. So you're not going to go.
We have to eat.
Okay, you're not going to go hungry.
I mean,
All right.
There's Jimmy John's. I loved me Jimmy John's when I was in college.
I think I even mentioned the restaurant last time.
Okay.
Remember, I asked you permission whether I could name a restaurant.
Yeah, what was it?
Avec.
Avec.
Oh, you did mention this. He did mention
I'm going back there.
Oh, you are? Of course. Of course. All right, Sam Fazeli, thank you so much for stopping in on your way from London out to Chicago. Sam Fazeli covers all the pharmaceutical stuff for Bloomberg Intelligence. He manages the folks over in London. Pretty much does it all, so we appreciate getting a few minutes of his time. Looking at the market here, as John Tucker's been reporting all morning, not a whole lot going on. A little bit of red on the screen. The S&P's off about 11 points. Coming up, Mary Ross Gilbert, Bloomberg Intelligence, senior equity analyst covering retail. We're going to get her thoughts on Macy's. Not so good. Abercrombie, pretty good. So we had some retail earnings. We'll get the latest. This is Bloomberg.
This is Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Wednesday, everybody. Happy Hump Day. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news of business, economics, politics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. Retail not having a terrible day today. Macy's stock is up by over 1% after posting better than expected quarterly results. Comp sales falling less than analysts had anticipated, so not as bad is always the win when it comes for earnings. Let's get more on this with Mary Ross Gilbert, Bloomberg Intelligence senior equity analyst who covers retail. All right, let's start with Macy's. Less bad than feared. What are the green shoots here?
Yeah, so I think the green shoots here is that Macy's is showing some traction here with their refresh strategy. When you look at their 125 stores that they've refreshed and they've expanded that to include some additional stores, their comp sales were down about 2%, about 1.9 is the figure that they're using. And, you know, look, Dillard's outperformed because they were down 1%. So they're getting better, but where they really need to improve is on the service levels. Where you also saw strength here is really on the luxury side, and that's Bloomingdale's. Bloomingdale's was up 3.8%, and Blue Mercury, which is their specialty beauty growth concept, and that was up 1.5%. So that's where you're really seeing strength, but it's such a small piece of the business. It's really all about the Macy's nameplate. And we still need to see better traction there, but it's getting better and better. And with regard to the tariff hits, it's going to be about 20 to 40 basis points, so very manageable. They directly source about, you know, we estimate that their private label business is about 13 to 14%. That's on a consolidated basis of sales. And so they're sourcing about 27% from China directly. So they have a number of initiatives that are helping them to offset the full effect of tariffs, which you'll see the biggest hit in the second quarter. But for the full year, it's very manageable, you know, in that 20 to 40 basis point impact.
Mary, for Macy's, are they comfortable with their store footprint these days?
So, Paul, they're reducing their store footprint with the Macy's nameplate. With some of the stores that they're closing, they've already closed 64. The total that they plan to close is 150. Wow. So they sort of feel like the go-forward store base is about 350 stores. But right now there's a little bit of a pause, you know, just because of the real estate market and some of the store closures that they have planned for this year. But yes, no, they need to take that store base down.
All right, let's go to the other one, the highlight here, Abercrombie & Fitch. I'm kind of floored by this. Like, we saw it with Urban, we saw it with American Eagle. Like, these specialty stores, they seem to be somewhat cyclical in nature, and they're crushing it right now.
Yeah, I mean, you can say Abercrombie is crushing it. They kind of are, but I mean, if you look at the namesake brand, the Abercrombie & Fitch brand, that was actually down 10% on a comp sales basis. But in all fairness, they were going against a 29% increase in the prior year first quarter. In a way, you'd say, look, that's no excuse. And certainly they were impacted in the quarter by lower average unit retail. That was because they had some carryover inventory from the winter season. And also, it looks like they had a little bit of a miss on their bridal, you know, the wedding business. But where they did have some strength was in swim. They really chased after it. So they've really got a good sort of summer shop going, and they expect that Abercrombie will inflect back to positive in the second half of the year. Where you really saw the strength was Hollister. So Hollister turned in a nice 23% comp sales gain, and that was on top of a double-digit gain last year. So they're really hitting it out of the ballpark, you know, with the teen Gen Z retail customer there.
So, I mean, if I look at the stock for Abercrombie, the good news is up 24% year to today. The bad news is down 35% this year. Hey, Mary, what are the Macy's and the Abercrombies of the world? What are they saying about the consumer right now?
Yeah, so Macy's is taking a very cautious perspective on the consumer. We think the consumer is pretty resilient. I mean, clearly at the higher end, they're more resilient than at the lower end, and there's some caution in there. But generally, I would say, you know, when we have employment levels, in that sort of unemployment levels in that sort of 4% range, that's really full employment. And when you're employed, you feel good about spending money. So we really think it's holding up. We think retailers are taking a cautious, conservative approach, hoping to be able to beat, and we think they probably can, particularly as we get into the back half of the year and they're able to allay more of the tariff impact as well.
Before we let you go, how are inventories across the board in retail? Have they managed them well enough to avoid a massive discounting round?
Yeah, so that's a good point. I mean, with Macy's, there are some carryover inventory that they are going to be flowing through the second quarter, and that's going to take a hit on margin. Same with Abercrombie. There's going to be a little bit of effect there in some of their inventory in the second quarter, but generally, they are doing a much better job. They've invested in systems, data, analytics, and they're also using generative AI, and that's making them more efficient. So we think that inventory levels generally are much better than they were years ago. But yes, they're doing a good job.
All right, Mary, thanks a lot. Really appreciate it, Mary Ross Gilbert joining us. She covers retail, a senior equity analyst over at Bloomberg Intelligence. Do you like how I asked that inventory question, which is really a discount question, which is really where does Alex shop?
And you did not get the answer that you wanted.
I really didn't. Good job for retailers, not good for Alex's shopping. All right, for our listeners in the U.S., here's a reminder. Listen to us via satellite radio on Sirius XM, channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now. As the equity market goes, absolutely nowhere. Trading a little heavy, maybe down 0.3% for the NASDAQ. Volume, though, really light as we wait for NVIDIA earnings after the bell.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, guys, happy Monday. No, it's not Monday.
Wednesday.
What was that?
Wednesday.
That's a good thing. I think it's Monday, but it's really Wednesday.
Wednesday.
Yeah, all right. Happy Wednesday. This is Hump Day. It's NVIDIA Day. It's the Fed Minutes Day. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great hour lined up for you as we head to those Fed Minutes and head to earnings after the closing bell. We're going to hit on fixed income with Ruben Hoven-Isian, General Portfolio Manager at TCW. We're also going to talk to Lindsay Dutch of Bloomberg Intelligence to break down Dick's Sporting Goods maintaining its outlook ahead of its Foot Locker deal. Also, Danielle DiMartino Booth, one of the best CEO and chief strategists for QI Research. Send in your questions, guys. This is coming up ahead of those Fed minutes. And Ellen Wald, president of Transversal Consulting, will join us to preview OPEC oil and the meeting that will be taking place on May 31st. But let's kick it all off for you right now with the Bloomberg Business Flash. And for that, we go to John Tucker.
All right, the major stock average is lower to little change in the run-up to the results from NVIDIA, the last of the Mag 7 mega caps to report. That comes after the close. We're also going to be interviewing the CEO, Jensen Huang, so you want to tune in for that. Right now, the S&P 500, 12 points lower. That's down 0.2%, 5908 on the index. The Dow Jones Industrial Average, 81 points lower. That's down just about 0.2%. The Nasdaq 100, 20 points lower. That is down about 0.1%. Daniel Morris said BNP Paribas says investors should expect more volatility.
Well, in our multi-asset portfolio, we're slightly overweight equity, so an implicit, I guess, in that view, or in that position is a view that on balance things should be resolved. But there's a lot of countries talking with the U.S. right now, a lot of things that the U.S. wants that the other countries may not necessarily want to give.
You mentioned Dick's, Alex. Dick's Sporting Goods maintaining its sales and profit forecast. A sign of strength as they prepare to acquire Foot Locker. And Dick's right now is up about 0.6%. The Trump administration rescinding 2022 U.S. Labor Department guidance that discouraged workplace 401k cryptocurrency investing. Remember, this is your retirement account, folks. We told you yesterday, Southwest bags fly free policy ending today. Southwest will charge $35 for one check bag, $45 for a second. But it won't just impact your wallet. Flight check-in lines could grow because it takes time to pay for the bags. The number of carry-ons expected to rise as we all try to save money. That will slow boarding and threaten on-time departures for Southwest.
The only time I check a bag is when I go skiing and I check my ski boots. That's it.
Yeah, but we're also assuming that normally all flights are on time. I'm not just ribbing Southwest. I'm ribbing like all airlines.
No, they actually have a pretty good on-time record. And by the way, when you're on time, that's the point at which you leave the gate.
Nah, so you can then stay on the tarmac for an hour and
Well,
it still
that's
counts.
Same for New Jersey Transit. When you pull out of station, go 10 yards, they've left on time, and then they sit there for 20 minutes while they wait for the tunnel to open up.
Excellent. We love this.
Well, don't give me any ideas. They're going to start charging for bags. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, JT, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube. And we're also on that smart TV stuff. Think Roku, Samsung TV, all that kind of good stuff. You just go to Bloomberg Originals, and that's where you find us. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Alex Steele, and we're joined by Bloomberg's Norma Linda. Norma, what are you looking at?
Well, I've got eyes on FICO. We're seeing shares that snapped 5 days of losses. We're seeing them higher as much as 7.7% this morning. And that's after Baird raised the recommendation on the credit analytics agency to outperform from neutral. And of course, we know in recent days, the company has really been in focus after FHFA Director Bill Pulte said that he's still not happy with FICO and that his agency will be making some decisions on the rising cost of credit score reports in the coming weeks. So this is a good welcome pop for the stock that's really been struggling over the past recent days.
Yeah, I have never heard of this company until John started talking about this last
who's
week.
Isaac? Fair Isaac? We know FICO, but...
Right, I know. It's
based in Bozeman, Montana, I think.
Now he knows. Now he's like, I know where that's located. Yep. You're on it. You're on it now. All right. How about Abercrombie & Fitch?
Yeah, Abercrombie & Fitch, this is a name that's really, really seeing a surge today. It's up for its best day ever. Shares are climbing as much as 36%, and this is after it raised its outlook despite the cost of tariffs. I mean, of course, we've been looking at companies across the board, but really retailers and how they're adjusting, especially when we think about tariffs and what's going on in China. But we've actually seen in recent years, Abercrombie has really been reducing its exposure to China. So we did have the CEO today saying that they don't plan broad-based tariff hikes in terms of prices and whatnot from the retailer.
And what else we got here? Third name, Fannie Mae. What's going on?
Fannie Mae and Freddie Mac. So this has been something I've been covering super closely, but we've got the two companies really in focus because of this idea that they could be coming back to public markets. Of course, we know that you can still see them trading, but they're over-the-counter stocks. But Trump essentially has been saying that he really wants to bring these two companies out of conservatorship, and they've really been under this government purview for about 15 years. So I think everyone's just pretty much watching to see whether or not this administration will be the one to do it. And we're seeing shares getting a bit of a pop after Trump is saying that they will retain the guarantees, that implicit guarantee that's really been in focus over recent years.
Because in theory, then it shouldn't affect everybody's mortgage rate, their 30-year fix.
Well,
like
that's
in theory,
the fear.
right?
That's the fear. So I think they're really threading a really tight needle here as to whether or not they're able to do that successfully without affecting the mortgage sector.
So they've been under government
conservatorship
since the financial crisis.
Yep.
Remember those days.
Oh, yeah.
Trying to forget them.
All right, Nora, thanks a lot. Norma Linda joining us from Bloomberg News. For more conversations just like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports and the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere that you listen. All right, let's get to the bond market here. You're seeing a little bit of a sell-off in the long end, kind of what the direction is as we head into those 2 p.m. Fed minutes. Ruben Hovhannissian. Did I get that?
That's close enough.
Was I close?
He's been
Managing Director, Generalist Portfolio Manager in the Fixed Income Group over at TWC. Was I close?
It was close enough.
Close enough.
He's being polite.
He's being polite. I'll still take it. Okay, what is the direction of travel for the long end?
We think the direction of travel is more volatility and choppiness. I mean, we really think that the long end of the curve has been suffering from lack of sponsorship due to some fiscal concerns, due to higher term premium, due to policy uncertainty, and some de-dollarization. And de-dollarization, I want to stress that we're not talking about outright selling of U.S. assets. Maybe that's happening, but we have not seen any evidence of that. But to put things in context, we have been running about $1 trillion of current account deficit for a number of years, and that means that we've been recipients of financial flows into the United States for a long time, and probably increasingly more so in the last couple of years. So even the reduction of some appetite in U.S. assets in general would lead to increase in risk premia for U.S. assets in general, and that would translate into more volatility for bonds, and especially at the long end of the curve where the rates are less anchored by the monetary policy of the Fed. And that's what we've seen on a year-to-date basis. There's been a lot of volatility, and that's probably an understatement in the rates market. But when you zoom out and take a look at the year-to-date changes, you will see that we have seen a twist steepening of the curve, whereby the front end, the 2s and 5s have declined. Rates have declined on a year-to-date basis, and by the way, driven by real yields. And the long end of the curve, the 20s and 30s, have increased, again, driven mainly by the real yields on a year-to-date basis.
Ruben, given that background here, the uncertainty caused in part by uncertain tariff policy, can the Fed really do anything here? I mean, it just doesn't seem like their toolbox is kind of equipped for this.
They're in a very tough spot because we think they do understand that the tariff policy and uncertainty, all else being equal, is going to lead to a deceleration of U.S. growth. At the same time, they're looking at the inflation expectations that have spiked and have, in some cases, have surpassed, are at record highs. And given their dual mandate and given their concern about inflation becoming entrenched and self-reinforcing, we think, excuse me, at least in the near term, they are going to be very patient, which they have been transmitting, which they have been telegraphing to us, that they're going to be very patient because last thing they want is inflation to start re-accelerating again. And remember, this is a Fed that has been blamed for being behind the curve and letting the inflation genie out of the bottle in 2022. So last thing they want is a repeat of that experience. And I mean, it may have. I mean, we do think tariffs are going to be a one-time price increase, and we think the link between a one-time price increase and entrenched self-reinforcing inflation is labor market, which we think has been weakening and will continue to weaken. So we don't think, given the information and facts we have here, we don't think that one-time price increase from tariffs will become entrenched and self-reinforcing. That being said, the Fed seems to be very concerned about that, which means that they will probably be patient in the very near term. I'm talking about the next month or two to see where things shake out.
How volatile do you think the Treasury market stays in this environment? Because some say it's not the actual level of yield that's going to affect the equity market, for example, but that volatility. Will volatility be sticky?
We think it will be sticky. I mean, look, we are about 2 months post-Liberation Day, and we've only struck one deal with the UK, and that's arguably not one of the most controversial deals and negotiations. So we have a lot of negotiations to go through. And even if you assume that August is the deadline and we'll have something, that means that for the next couple of months, we are going to see a lot of policy uncertainty, which leads to volatility and also leads to reduced confidence, especially for businesses who need more stability to start investing and thinking about multi-billion, multi-year projects.
Ruben, what kind of credit risk are you guys taking in TCW?
We added credit in April on volatility when rates spiked about 40 bips in IG and about 200 basis points in high yield. We were actively adding risk. Now that all of that widening has been retraced in the last couple of weeks, we have been reducing some of the ads from early April. So we're still looking at the valuations today in credit markets compared to securitized markets. We still think that securitized markets offer better valuations, and we are leaning more heavily on securitized in strategies where we can have securitized and credit, of course, and we're underweight credit at these levels. That being said, again, we added a lot in April, and we've taken it off, some of it off.
All right, Ruben, good stuff. Thanks so much for joining us. Ruben Hovhannissian, General Portfolio Manager, TCW's Fixed Income Group. They're based in Los Angeles. That dude's all in on LA. He works in LA, goes to undergraduate at UCLA, and gets his MBA at UCLA. So all in on the UCLA game there. Let's get back to earnings here. We got some more retailers. Dick's Sporting Goods came out with some numbers here. Maintains their outlook. I think like maintaining an outlook today is almost like a beat and raise back in the day. I mean,
so true.
If you're keeping it. So Lindsay Dutch joins us. She covers all the consumer hardlines for Bloomberg Intelligence. Talk to us about what you saw from Dick's Sporting Goods today, Lindsay.
Hi, thanks for having me, Paul and Alex. Yes, so the numbers, Dick's did pre-announce when they announced their Foot Locker deal a couple weeks ago, and numbers were in line with their pre-announcement, but the key focus was that guidance, what they left where they set it at the beginning of the year, and it really tells us, you know, combined with the strong first quarter results, that demand is holding very strong for this company, and we should continue to see growth in coming quarters, and tariffs with the rising costs there should be manageable for the rest of the year.
What changed? Because I feel like before earnings season, we thought this was going to be just like total disaster for retailers when it came to tariffs. Did something fundamentally change, or did we just not give them enough credit?
So I think Dick's might not be a barometer for retailers across the board. I think they're uniquely positioned in a couple of ways. One is that their consumer base is a higher income consumer. That consumer has been holding up pretty well, and we haven't seen a change, you know, in the spending patterns for them yet. The other piece I would say is, you know, Dick's has done a really great job improving their assortment. And because they carry, you know, premium brands, they are in a very good position to pass through these higher costs to that consumer. And we expect that more affluent consumer to continue to spend on Nike, even if it's 5% higher in terms of the shoe that you're picking. So it is manageable, you know, for Dick's, and, you know, that might not be the case across the board, but they are positioned to do so.
Lindsay, I'm just guessing that my sneakers were not stitched in Peoria, Illinois. So what are they saying about tariffs and the impact on their margins?
Right. So we haven't gotten a lot of specific details, but in the guidance, they are still expecting about 75 basis points of gross margin expansion this year. So that expectation of growing margin is still in place. Like I said, I think that they're looking to pass those higher costs on to consumers, so that's sort of a margin neutral impact. And the way they're getting the expansion on the margin line is, you know, Dick's has really pulled back on promotions. They don't really offer blanket discounts. You never see 20% off the entire site, not even on Black Friday. They just don't do that anymore, and they haven't really done that since the pandemic. You know, once they saw that consumers really are interested in sports, fitness, athleisure, they will pay the full price, and they plan to continue to sell through on the full price for the rest of the year.
What other stocks in your coverage are holding up surprisingly well?
Yeah, so that's a great question, Alex. So we had Williams-Sonoma report last week, and they too held their guidance flat. Very similar backdrop for them. Again, it's a higher income consumer. They are seeing demand, you know, for the price point of their goods, especially in the Williams-Sonoma home brand. That's performed very well. They're also making inroads with kids and their teen Pottery Barn brand. So that's another one, you know, very similar to Dick's. You know, both kind of entered the year with strong demand momentum, and we saw that demand continue into the first quarter, and it looks like it could continue to extend this year.
Remind us on the deal for Foot Locker. Is this deal going to get approved? Just remind us, because that seems like, I don't know about that.
Yes, so our antitrust expert, Jen Rhee, you know, took a look at the deal, and she thinks that it's highly likely that it will be approved by the FTC. She doesn't see a lot of hurdles there. There might be some, you know, store divestitures, but one interesting thing that came up on the Dick's call today, you know, is part of their merger agreement is that they're only really willing to sell about $100 million worth of Foot Locker stores. Right. As long as the FTC is good with that low amount, you know, Dick's would obviously proceed with the deal. They're looking to get exposure to a broader consumer base, and those mall-based stores are really a key component to the deal.
All right, Lindsay Dutch, thank you so much. We appreciate that. Consumer Hardline Senior Analyst for Bloomberg Intelligence, Dick's Sporting Goods, reporting earnings, keeping their guidance. Again, that kind of feels like a win for some companies these days. A lot of companies pulling their guidance, lowering their guidance on an uncertain economic outlook. But in the world of sneakers, all is good, I guess. We'll have more coming up. This is Bloomberg.
I'm going to bring in Ben, you bring in Danielle.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Let's see if your company qualifies at oracle.com/Bloomberg. Of course, the next big test for Wall Street comes after the end of regular trading in New York when the market heavyweight NVIDIA reports the latest results, and we're going to interview the CEO, Jensen Huang, right around 6:30 Wall Street time. Macy's sales and profits slipping in the first quarter, and the department store cited more cautious customers and the impact of the trade war trimming its profit forecast for this year. Abercrombie & Fitch soared after its profit and revenue both topped analyst expectations. Those shares right now up close to 19%. Overall, the S&P 500 down 11 points. That's a decline of about 0.2%. Light volume too today. Dow Jones Industrial Average down 103 points. That's down about 0.25%. The NASDAQ 100, that's just turned higher, 5 points higher at 21,421. This feels like it's been going on forever. Wells Fargo CEO Charlie Sharp says the bank far along in fulfilling requirements to end the Federal Reserve's growth ban. That's been in place for over 7 years. The Fed imposed the asset cap after a raft of scandals related to their sales practices. I actually got an account I didn't even know about from Wells Fargo.
I got my checking account there.
Oh, yeah?
Yeah, I had my California mortgage with them. It all went smoothly.
Anyway.
Of course, they sold it 15 minutes after I closed.
Of course, yeah, I mean, please.
Yeah.
So did mine.
Yes.
It ended up somewhere else,
But I mean, the terms and everything, you're still like in the twos, right?
And who doesn't want my mortgage?
Exactly.
2.75%? Like, everyone wants my
She's got
mortgage.
every opportunity. She's got to brag.
Yeah, but you also set me up for it, so it's not totally my fault.
Anyway, that's your market update, kids.
All right, JT, Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Check us out on YouTube, which apparently everyone's watching now, as well as the originals, which you can find on Roku and all your smart TV. Check us out there as well. One of the headlines, obviously, as JT was talking about, was Fannie Mae now saying that it will keep its U.S. guarantee as a public firm. I should say President Trump has said that Fannie Mae may keep its U.S. guarantee as a public firm. Ben Elliott is consumer finance analyst for Bloomberg Intelligence, joins us from Washington, D.C. So does this imply that there should be then no change to people's mortgages and the rates?
Well, it's interesting because while President Trump has confirmed that he'd like to keep the U.S. government involved with Fannie and Freddie, and that's a big deal, we still have no details on sort of the contours of the guarantee, and the way that that plays out eventually could have an impact on the mortgage market.
Ben, tell us, just refresh our memory, because I'm going to speak for everyone in our audience. I have no idea how this ownership thing is of Fannie and Freddie. Could you just refresh who owns what and what's President Trump thinking about here?
Yeah, so the federal government owns a senior class of shares that has varying sort of levels of valuation applied to it, but it's probably worth hundreds of billions of dollars. And then the federal government also owns warrants to purchase 79.9% of the common stock. And so the remaining common stock still trades, but it has no voting power, and it has limited sort of economic claims on the businesses.
So if that's the case, like, what would ownership or still a backstop by the government to Fannie, but public ownership mean? Like, what is that? That doesn't make any sense to me.
Yeah, so the way the companies are governed right now, something called the Preferred Stock Purchase Agreement is in place. That dates back to 2008. And there's still about $270 billion of liquidity that Treasury has pledged to the enterprises individually, actually. So there's different amounts pledged to each company. So presumably what the president is talking about is maintaining the PSPA guarantees, but charging the enterprises some sort of fee in exchange for that liquidity going forward.
So, Ben, you know, as a citizen and a taxpayer, I don't think I want my government really in the loan business to this degree. So isn't don't people want them to get out of this business, sell down?
It's interesting. So Fannie and Freddie actually work extremely well under the status quo. You know, in some ways, I think you might want the government to be in this business. If you look across the globe, the U.S. is really the only country that has this level of liquidity in the mortgage market. The 30-year fixed rate note is something of a unique sort of financial instrument available to U.S. home buyers. And as a result, U.S. home ownership rates are higher than many other nations across the globe. So there is a reason for the U.S. government to be involved. But to your point, they shouldn't be too involved. And we learned that lesson in 2008. And that was actually, so it's interesting, the president tweeted he wanted to keep the implicit guarantee, which is what existed prior to 2008, when basically everyone agreed that Treasury would be on the hook if something happened. We saw that something did happen and Treasury was on the hook. So I think what people would like to see going forward is the government sort of set some strong guardrails around this and say, you know, we're going to backstop this, but only in a very sort of narrow, explicit way.
All I know is if I'm a FIG banker, financial institutions group, if I'm a FIG banker on Wall Street, I'm pitching this deal hard. Think how big this offering would be.
I mean,
he's all about fees.
I'm all about fees.
You know,
you got to get paid.
You can take the banker out of the location, but whatever, something along those lines.
My partnership evaluation at Solomon Brothers, the best thing was he's not afraid to ask for the ticket. You got to get paid.
Yeah.
Talk all you want. Ben Elliott, thank you so much. Consumer finance analyst at Bloomberg Intelligence. We got Fed minutes today. I don't know if I never pay attention to it. I just wait for like Ira Jersey to tell me if it's important. But I know a lot.
You're really selling it here,
I know
Paul.
a lot of people are all over this, and our next guest is really one of the leading voices that we have to talk to us about the Fed and the markets. Danielle DiMartino Booth, CEO, Chief Strategist for QI Research, joins us here in our studio. Are Fed minutes important anymore, Danielle? Because it seems like they talk all the time.
Yeah, it's kind of nonstop. I'm counting the seconds until next Friday when we go into FOMC blackout, but then I need to get out more. I'm not really expecting any surprises from today. I think that they want to continue to broadcast this air of utter uncertainty, even though I guess the irony is that a lot of other indicators are kind of flashing to the Fed that they've really got their eye on the wrong ball right now.
What ball should they have their eye on?
Well, yesterday was kind of unusual. We had CoreLogic and FHFA monthly home prices for March very lagged, but the Fed knows that these are lagging indicators. Both print negative for the month for the first time since June of 2022. And we're seeing that shelter component, which is the largest input to inflation, really start to come down hard as multifamily supply continues to flood the market. So both on the rental and on the home price side of shelter, the Fed is really going to have to start contending with disinflation. The 2019 FOMC minutes, in fact, found that the drag on the labor market and the drag on GDP growth was more than overwhelmed any inflationary impulse from the tariffs. They released those transcripts just a few months ago. So the Fed's got all kinds of other issues to contend with. At BCY Go on the Bloomberg terminal, we're up to 21 large bankruptcies. We've had 3 multi-billion bankruptcies filed just today in the United States. To give you an idea of what 21 looks like for the month, August 2023 was the absolute peak for the cycle. So it looks like we're going to cruise right past that. We saw on Bloomberg News last night that At Home is getting ready to file, a big retailer. Wolfspeed's also right there in the queue to file as well. So the Fed's got some other issues I think it needs to be focused on right now.
Do you think they look at that, like the knock against the Fed, which you have educated us on, and others like Cam Harvey do, because they don't really, sometimes they don't look at the right data.
Well, that's true. That's very true. But when it comes to, trust me when I say, after almost a decade inside the Fed, long lagging indicators that start to move owner's equivalent rent, and when you see a double negative print, those are the kind of things that really get the attention of the PhDs. They're like, oh wow, that took a long time to show up in the data, and it doesn't turn for a very long time either. And these are seasonally adjusted, very, very long series that, yes, the Fed does pay attention to.
So when we have the narrative of when the hard data catches up to the soft data, blah, 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 is that narrative, like, is that the right narrative? Or have we already seen it start to catch up in different ways?
Oh, I mean, the good news is, if the Fed is going to be discussing this, is that the hard data has caught up. Right, the Bureau of Labor Statistics on, and Anna Wong does a great job with this data as well, but the Bureau of Labor Statistics on May the 7th released the BED data that's based on 12 million U.S. employers. It's the hardest of the hard data. And we saw that in the 6 months ended September of last year that there were net job losses, meaning that when the NBER goes back and looks at all of this, it's as hard as the data gets. It doesn't get any harder, and it indicates that recession likely began in 2024's first quarter. Again, this is as hard as the Bureau of Labor Statistics data get. There'll be special presentations at the upcoming FOMC just based on the depth of these revisions, which really haven't been this material, if you will, since 2008.
Wow. So I guess June, don't expect anything from the Fed. How about September?
Maybe September. I mean, I think my point of walking through this litany of not soft survey data, but hard data, is that if the Fed is intent on ignoring data that are very familiar to them, this is not University of Michigan, this is not Conference Board, this is Bureau of Labor Statistics hard data. If their intent to look past that, the quarterly census of employment and wages comes out for the fourth quarter of 2024 on June the 4th. Of course, we've got another non-farm payrolls report that arrives as well. If they're just going to keep looking past this, that means that they don't want to move and that they're going to have their own reasons and fall back on them to say we're not doing anything until September the 17th.
Could they be good reasons, or do you think that's just passing the buck?
I don't think they're good reasons at this point, not from what we're hearing from the St. Louis Fed, that households in the top 10% of zip codes are seeing their credit card delinquencies deteriorate at a much faster pace than lower income. Torsten Slok put a good chart out yesterday morning that showed that white collar, the highest income cohort, is right now the fastest growing area of those claiming unemployment benefits. You know, you've got continuing claims stuck at 1.9 million. Again, I think right now Fed policymakers want to sit on their hands.
Yep. So Danielle, you're based in Dallas, 9 years at the Dallas Fed.
Yes.
Has the DFW Metroplex ever been in better economic shape than it is today? It seems like every company's moving there.
It is a bubble. There is a tremendous amount of corporate relocation going on there. We've got skyscrapers left and right. The Texas Stock Exchange is going to be opening up. That's pretty exciting for everybody in finance there. Of course, you know, JP Morgan. Many of the biggest U.S. banks have more employees in the finance field in the city of Dallas than they do in New York City.
Really?
Oh, yes.
Yeah, I mean, Goldman's about to open up.
Goldman's corporate campus there is enormous.
I've heard it's just amazing.
But, you know, it was interesting when you see that the 11th district where I worked for, again, nearly a decade, that's 10% of U.S. consumption. Wow. When you see that services data hit at 10:30 Eastern this morning and show that revenues have turned negative, you got an identical printout of Richmond Fed services, again, revenues negative, it's a big deal to see in my city, in the bubble, in the most really captured city in America, that we're seeing so many small retailers go out of business.
All right, Danielle, thank you so much. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, joining us live here in our Bloomberg Interactive Broker Studio, trying to get a sense of what's going on out there in this economy and the Federal Reserve. Coming up, let's talk oil and gas. We can do that with Ellen Wall, President of Transversal Consulting, Oil and Gas Markets. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Major stock averages pushing lower right now after yesterday's rally. NVIDIA shares, they have soared 40% from an April low. The world's most valuable chipmaker reports after the market close. The last of the Mag 7 stocks to do so. Wall Street estimates, they kind of vary widely on the impact of the U.S. Export restrictions on chips. Meantime, David Leibovitz at JP Morgan says investing right now involves delicate balance.
It's really about keeping one foot on either side of the line, having some exposure to risk assets to capture that upside as it materializes, but not having so much risk exposure that the market just moves you around as the headlines dictate the direction of travel.
And right now, the S&P 500, 14 points lower. That's down about 0.25%, 59.06 on the index. The Dow Jones Industrial Average, 144 points lower, and that is down 0.3%. The NASDAQ 100, 12 points lower. That is down just about 0.1%. And low volume today as we wait for those earnings after the close. Shake Shack introducing its first loyalty offerings. This includes $1 sodas for app users, discounts for customers who order a burger or a barbecue sandwich at least twice within a certain time period.
Air quotes.
I don't know what that means. QVC and HSN, the home shopping network, they're known for hawking everything from kitchen appliances to luggage. The company that owns them has more than $5 billion with a B dollars of debt. In the past 4 years, the stock price has fallen more than 99%. And now comes word they are huddling with advisors to evaluate their options with respect to that debt. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
Good buddy of mine used to sell stuff on QVC. She was a presenter, so she'd be hired by brands to go on there and, made a nice little living of it.
Well, it's kind of addictive for some folks at home just watching these people. And if you're a good presenter, there's a real connection, and people will buy.
And she made good money for like 20 years.
Stuff they just don't need.
Exactly. But now you've got the intraweb, and
I could see Alex on QVC and Home Shopping Network buying
hawking the
latest shoes.
Oh my God, I'd be so good.
Yeah, I know. I'm telling you.
No, I mean that as a buyer, like customer.
Oh, I've done that.
I bet you have.
But
I have to
only
say,
for sales.
That's where I got my Dyson. It was a really good deal.
See? You got to get the good deals.
Yeah.
John Tucker, very well. Appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. Let's talk global oil and gas. When we want to do that, we talked to Alex, but we also talked to Ellen Wald, president of Transversal Consulting and senior fellow at the Atlantic Council. Ellen, our friends in the U.S. shale patch, the oil patch, they're probably not that happy with $62 oil. What do they do at this level?
I think what we're seeing now is really a lot of the producers are making some very kind of calculated decisions. They're looking at what areas they can continue to produce in, and is it really worth it to drill new wells if the price point is, about $62 a barrel? And so they have to make decisions about what's worthwhile to produce and what's not, and is expansion worthwhile? And I do think a lot of that depends on the cost of production and whether they're going to be increasing costs on the steel that they need, on oil services and things like that. And so you see a lot of companies kind of holding back on making decisions about capital expansion in the shale patch. And then again, we're also seeing some of the larger shale companies expand internationally. They're looking for other areas to produce oil that are not Texas and the Permian because they're seeing better opportunities elsewhere.
So I take a look, this is going to get nerdy, guys, so let's get into it. I'm taking a look at the oil curve. So if you have a Bloomberg terminal, it's CCRV is the function, and it shows kind of what the market's expecting prices to be today versus prices in the future. This is an insanely weird chart, and I say that because prices right now are much higher than they are within the next year, and then everything turns around, and then prices get much higher again. So it's like this bumpy little curve that usually isn't how the oil market works. There's a clear oil signal for producers to say, all right, I have clear visibility into what oil prices are going to be in the next 3 years, and I'm going to go after it. This curve is an OPEC curve, is it not?
An OPEC curve. I like the way you describe that. I do think that right now what we are seeing is that OPEC is kind of in the driver's seat, so to speak, when they're looking at things. And in fact, they just concluded, another one of a meeting that they were having, and they are looking to use the baseline productions for 2025 to set they're looking to use production in 2025 to set baselines for 2026. So they are definitely looking farther into the future to see, and set production, because everybody likes it when OPEC makes it clear what they're going to do far in the future. Now, of course, that can be changed, as we've seen, and they certainly do like to, change things and do things month by month. But overall, if OPEC can give a clear indication of what they're planning to do in, for the rest of 2025, for all of 2026, then that's extremely helpful for producers in the U.S. and so on and so forth.
And a lot of that is to punish the cheaters, right? I mean, Kazakhstan's made no bones about the fact that it's overproducing what its quota should be, in part because they want to keep Western investment and they want the revenue. What does it mean when you have an OPEC that isn't abiding by the quotas?
So this is always an issue for them, and we've seen them deal with this with not just Kazakhstan, also Iraq. It's kind of a perennial overproducer, and Iraq is in a similar situation as Kazakhstan because it's got other companies, it's got Western companies that they've signed agreements with. They've got the northern area, which is basically oil production that's run by the Kurds, and they want to be much more independent. And so so they've got internal issues that affect their production. It's not just some guy sitting in an office saying, oh, we're going to overproduce this month. There are a lot of things that they are dealing with, just like Kazakhstan. And so they I think they're always going to be pushing the envelope when it comes to production quotas, and OPEC just kind of has to deal with this. I think at this point, yes, they want them to come in line, but more than that, they want unity. So they're going to push them, and they're going to see if they can get them to curb their production a little bit, or at least commit to it. But in the end, they're not going to say kick them out of OPEC or something like that, because it means more to have them in this group. I mean, we're coming up on the 10-year anniversary of this OPEC Plus group, which is really an incredible achievement. But at the same time, you've got these 8 countries in OPEC Plus that have voluntarily reduced their production levels, and they're saying, hey, if Kazakhstan and other countries are constantly overproducing, well, why are we continuing to hold back this oil from the market? And so that's why we're seeing, these countries get together and saying, okay, we're going to put another, say, 400,000 barrels on the market this month and next month. And I think that is something that they can do because it's just the 8 of them, and so they can get agreement on that much more easily than a whole group having to get everyone else in the group to agree, but also because it can kind of keep prices in check. They don't really want prices to get that high, because that means that all sorts of other production in the United States some suddenly becomes viable. And I don't think that they necessarily want to get $75, $80 oil prices, because that means that a whole lot more oil is going to be unleashed in other areas.
And I know from some good sources that
here we go,
oil men like between $75 and $85 a barrel. That's kind of the sweet spot.
It's a landman thing, Ellen.
It's a landman thing.
That's where he's getting his info.
Ellen Wald, President, Transversal Consulting and Senior Fellow.
Is fair game.
Yep, absolutely. She's President, Transversal Consulting and Senior Fellow at the Atlantic Council, joining us there. Is the cost of production higher or lower in the U.S. versus, say, like Saudi Arabia?
Cost of production is higher. The cost of production in the Saudi Arabia is like $20. It's really
nice.
cheap. But they have fiscally their break evens like 90 to 100.
Okay,
because of all that they're spending and stuff like that. But it's still relatively cheap. But on the margin, it's been going up a little bit. As you already drilled the good stuff, it gets more expensive to drill the tier 2, tier 3 stuff as well.
All right, WTI crude oil $62 here, up $1.50 today. Brent $65.50, up $1.39 today. So a little bit left to oil. All I know about oil is kind of supply and demand. You have to have an informed opinion on supply and demand for oil, as you do for any commodity, but especially for oil. Tough to trade that. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Today's the day. You got NVIDIA earnings coming out after the closing bell or right here in the United States. It's going to be the market mover. So the question is what to expect, what's priced in, and what's positioning like. So let's get right to it right now with Kujan Subani, Bloomberg Intelligence, a senior semi-analyst, joining us. Okay, what are the broad strokes that we're looking for from NVIDIA?
Well, the one thing very different this time is you have the sort of noisiest quarter over the last 3 years in terms of expectations. The deviation between estimate numbers is pretty wide, and that is because not every broker or not every analyst has fully integrated the impact of the China ban loss. And there's a lot of confusion around it, like how much should that impact be? So having said that, what it implies is the consensus, the beat or miss would be against a very messy consensus number. So we think investors should not pay a lot of attention as they would to an absolute beat and miss, but rather focus on the commentary around the ramp of GB200 and the GB300 transition expected in second half, clarity on the new China variant chip that they're working on, and if, as a bonus point, if Jensen can give us any color around second half and 2026 demand signals.
So, I mean, Jensen Huang is very good at doing all of that. Talk to us about the China situation. Is this variant trip, is it something that can be a fix, a short-term fix, a long-term fix? How do you view it?
I mean, this is not the first time we are in this situation. I think this is sort of the fourth time. Every time after every 6 to sort of 8 months, the US has put a sanction or a restriction on the chip that they were selling to China. And the company has very successfully come out and created a variant that is compliance and have started shipping and has produced more revenues than the prior chip. So this is the sort of the fourth time that they're doing. We feel very confident in their ability to make a China variant compliant chip and ship that until the next time maybe we see a sanction. But what's different this time around is this chip is going to be much less powerful and performance, and China, especially Huawei, has been coming up with their more competitive offerings. So this time around, there will be pricing pressure. We have heard some rumors that they might reduce the pricing significantly. And again, now you're sort of getting in line or getting below the competitive alternative, which is available locally.
When you take a look at, say, the margin issue, and that comes with the ramp up of the GB2000, GB3000, what can we expect there? What's like a good one? What's a bad one?
Yeah, so there's two headwinds on the margin side. One, as such, even if the China ban didn't exist, their margins were in pressure because of exactly what you said, the ramp from the new products. Now, we were expecting them, and the CFO did say that towards exiting this year, the margin should again creep up to sort of mid-70s. But now we think either in this quarter or in 2Q, there will be an impact to margin, a one-time impact from the China ban sales, as we saw with AMD earnings. Any commentary to reboost confidence that the margins will get back to the mid-70s this year should be definitely a positive, but any kind of lack of that or a delay of that structurally could really hurt the sentiment.
Where are we now, Kujan? What kind of demand is the market discounting these days? Have we seen peak AI demand, or is it still strong going forward?
I mean, from our checks and, disregarding any rumors, just going on pure data points, we don't see any slowdown in demand. When you look at the earnings from the top 4 cloud guys and the big hyperscalers, nobody has commented any kind of slowdown or signaled any kind of reduction in CapEx going into next year. We have seen the demand signals outside of this big, large cloud and hyperscaler group continue to expand. You have the UAE deal, you have the Stargate deal, and you see a lot more enterprises like XAI and other companies coming in and have started their plans to build up large data centers and GPU clusters. So we don't see any real tangible or measurable demand weakness so far.
This might be a silly question because it may be net for NVIDIA, but as we see the focus move away from those huge data centers where you're training the large language models more to the inference side, where you have to have, closer to cities, closer to like my phone, so I can interface with AI, does that change the kind of chips and the kind of demand for NVIDIA stuff?
Not in the near term. Inference has multiple stages. There's inference and data center, which is the largest piece of the market where the largest dollars are spent. Still, by the top 4 or 5 hyperscalers and cloud guys. And the inference sort of at the very edge, that market is just starting up. So the amount of dollars spent there in terms of chips is not very large there. When we do get to that market, it depends to see, if NVIDIA will lose the edge there and if someone like Qualcomm or Intel might gain the share there, but not so far. So far, still, NVIDIA has a dominant share when it comes to inference, which is still in data center.
All right, Kunjan, thank you so much. We appreciate that. Kunjan Sobhani, he is a senior analyst on semiconductors for Bloomberg Intelligence. He's based out there in San Francisco, right in the Valley. And again, we've got the NVIDIA earnings after the close today. Around 4:20 is when they hope to get them out the door. And then, of course, we'll have a conference call this evening, 5 p.m. Wall Street time. So a lot of folks are going to be tuning into that because it used to be a real driver for the market overall. But Gina Martin Adams from Bloomberg Intelligence is suggesting that's peaked. So it's important, but not quite as important.
Right, you can see in the options market, calculating a 6% move to the upper downside versus over 8%. This is according to Citi. Also, it's been, but on the but side, the S&P has been the one that's leading everything higher, not the equal weighted index, which makes me think that tech maybe still has a little bit of more sway within the overall market direction. Well, for our listeners in the U.S., here's a reminder for you. You can listen to us via satellite radio on SiriusXM channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on SiriusXM channel 121 is presented by Ship Station. Stay with us. Your top stories and global business headlines are coming up right now as you're looking at the NASDAQ off by 0.2%, the Dow off 0.4, and the S&P off 0.3%, and bonds sell off a touch. This is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. New visa restriction policies emerging from the State Department. One will apply to foreign officials and people who are, quote, complicit in censoring Americans. Another stops the scheduling of new visa interviews for foreign students. CBS's Natalie Brand says that's billed as temporary as screening of social media activity is expanded.
It's hard to really know how this impacts those students who are going to be waiting for appointments, how long this pause in interviews lasts. But we do know that, the administration has taken action against other student visa holders. There have been various court cases, and many of them successful.
For the third straight time, a destructive failure of a SpaceX Starship rocket has raised questions about when it will be ready to fly astronauts. Elon Musk offers this timetable.
If we're lucky, we've probably got about a 50% chance of sending ships from Earth to Mars at the end of next year. So November, December next year, in about 18 months.
Well, CBS's Jason Allen on today's Setback.
From the new officially named city of Starbase, Texas, SpaceX's Starship successfully lifted off, but flew into trouble minutes later. As the booster returned to Earth, a flash of flame erupted. People watching from Texas beaches could see the booster explode in the air.
Israel said today recent strikes in Gaza killed a top Hamas leader, Mohammed Sinwar. The Capitol Police Chief is retiring this week. Thomas Manger took over the department after the January 6th attack.
It was, I think, a slap in the face to every police officer that was here.
CBS's Scott McFarland.
This is a historic tenure at a fragile moment. It was a traumatized police department after the U.S. Capitol siege that was understaffed and faced the mission of ensuring no other attacks on the Capitol happen again. Thomas Manger rebuilt some of that staff. He increased the budget for the department. They're going to ask for $1 billion next year to better secure the Congress, the Capitol, and members of Congress as they travel the country.
More testimony of the Sean Combs sex trafficking trial from a former assistant, Capricorn Clark. CBS's Katrina Kaufman.
There were two instances where she claims she was kidnapped. One is she was in possession of some diamond jewelry. She reported that it had gone missing, and she said over the course of 5 days, she was brought to a dilapidated building and subjected to lie detector tests. The man there, she said, told her that if things didn't get figured out, she would end up in the East River.
And checking Wall Street, right now the Dow Jones Industrial Average down 130. This is CBS News. A new report forecasts an ever-warming planet Earth.
I'm Vicki Barker at the Foreign Desk in London. The UN's climate agency says the world is on course to experience more record temperatures over the next 5 years, with a high likelihood that average warming will exceed the limit set by the Paris Climate Accords. The World Meteorological Organization says the Arctic will likely warm at more than 3 times the global average. Among other things, that would see thawing permafrost releasing greenhouse gases into the atmosphere, accelerating climate change. Vicki Barker, CBS News, London.
The governing body for California high school sports has changed the rules for this weekend's state track and field championship, allowing more girls to qualify. It comes after a trans athlete secured a place at the event. President Trump has threatened to pull federal funding if California does not bar trans girls from participating in girls' sports. I'm Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
President Trump's embrace of crypto comes into full form in Las Vegas. Welcome to the Wednesday edition of Balance of Power as MAGA converges on the Bitcoin conference today, complete with a keynote from Vice President J.D. Vance, who's about to hit the stage. We're going to look at what the Trump White House is looking for from crypto and the Trump family, for that matter, and what this conference might do to move the ball. Straight ahead with Nathan Dean at Bloomberg Intelligence. SpaceX loses another Starship, as we learned live on the air last evening. We're going to dig into what happened on the 9th test launch, what it means for Elon Musk's drive to Mars, with Bloomberg's Ed Ludlow and Mike Shepard later this hour, with analysis today from our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us for the duration, and we start, as always, with our look at the markets. That includes crypto. Charlie Pellet has the word from World Headquarters in New York. Hey, Charlie.
Well, hello there, Joe Matthew. Bitcoin right now down 2.1%, 107,274 on Bitcoin. A lower day for risk assets. The Dow, the S&P, NASDAQ, all declining. S&P right now down 13. Drop there of 0.2%. We've got the Dow down 122. Lower by 0.3%, and NASDAQ right now down 19. For NASDAQ, that is a drop of 0.1%. Again, the S&P down 0.2% right now. Keep in mind, yesterday the S&P surged 2%. 10-year at 4.49%, with a 2-year that's currently yielding 3.99%. Gold is down $4 the ounce to $32.96, a drop of 0.1%. And a rally for West Texas Intermediate crude, 62.22 a barrel now, up by 2.1%, and Bitcoin bears repeating, down 2.1% now, $107,000, 334 on Bitcoin. David Leibovitz is global market strategist at J.P. Morgan Investment Management. He says investors are now looking beyond tariffs.
The trade issue is not going away, right? We're going to have tariffs. They are going to be higher than they were at the start of the year. How much higher? Time will tell. The drag from tariffs, though, continues to be pushed out. And what I think the administration is trying to do today is play more of a timing game, where if they continue to kick the can on the tariffs towards the end of the year, then the impact on the economy only shows up as you're getting that fiscal thrust in 2026.
David Leibovitz of J.P. Morgan Investment Management interviewed this morning on surveillance. You can hear more of the conversation on the Surveillance podcast. Macy's out with better-than-expected quarterly results on a down day for stocks. We do have Macy's up by 1.8%. Also reporting earnings this morning, Abercrombie & Fitch now up 19%. The retailer upped its full-year outlook. The big story after the close of trading today going to be earnings out of NVIDIA. NVIDIA shares ahead of earnings, up by 0.3%. And Bloomberg's Ed Ludlow will be sitting down with NVIDIA CEO Jensen Huang tonight, 6:30 p.m. Wall Street time. You can hear the conversation on Bloomberg. Recapping, stocks lower, S&P down 0.2%. Balance of Power continues now. Back we go to Washington. Once again, your host. Here he is, Joe Matthew.
All right, Charlie Pellet, many thanks, sir. Live from New York, watching Wall Street for us every day here on the fastest show in politics. Welcome to the Wednesday edition. Yeah, it's already Wednesday in our shortened trading week here on Bloomberg Radio, satellite radio, channel 121. On YouTube, search Bloomberg Business News Live to catch all of our shows throughout the day, live from Washington and New York, as well available now on Bloomberg Originals. have I told you about the podcast? It's good to have you along with our eyes on the Oval Office. We may bring you there this hour. I just want to give you fair warning. President Trump holding a swearing-in ceremony for Judge Jeanine. Remember, tapped to serve as interim U.S. Attorney for the District of Columbia here in the federal city. So the podium's going to be set up. We've seen this more than once in the Oval. The question is, will Donald Trump be taking questions from reporters? We'll find out when we get there. It does look like we'll have a live feed from the Oval Office. Also watching the Vice President today, J.D. Vance, making tracks to Vegas, baby, where the full MAGA crypto community is in effect. And this is, if you're with us on YouTube, a live view on Bloomberg Originals of the podium set up in Vegas, Bitcoin 2025. The Vice President delivering the keynote address that Donald Trump himself delivered last year. Now, we've got a lot of headlines on crypto and President Trump and his family, for that matter. Just searching, a cursory search on the terminal will bring you a couple of pretty important developments over the past couple of days, whether it has to do with policy here in Washington, the family's investments in crypto, and more specifically, what's going on over at DJT. That policy, by the way, might end up impacting your 401k. And so we want to spend some time with our friend Nathan Dean, no stranger to crypto policy. It's something we talk about a lot around here, and we want to combine some of these headlines in a way that I think will be fascinating. Bloomberg Intelligence Senior U.S. Policy Analyst. Nathan, it's great to see you. A year ago, Donald Trump, remember, said that the U.S. would become a Bitcoin superpower at this event. Has he made good on that promise in the last year?
So they've started to make steps on moving towards that goal. But, you know, what we tell our clients all the time is that there's a lot of sentiment going on with crypto, especially in the policy space. And a lot of the policy actions, whether it's the Genius Act, the stablecoin bill, the broader market structure bill, or this idea of a strategic Bitcoin reserve, it takes time to cook. And so whether you're on the retail side and you're looking for a quick win or you're looking for speculation, you may get a different answer coming out of Washington than if you're an institutional investor and you're playing the long game. So again, there's a lot of positive momentum that's happening right now, but we're still just early steps in trying to become, you know, that big Bitcoin capital of the world that President Trump seeks.
Yeah, that's right. I don't know exactly how you define that either. I think at one point he was suggesting that all Bitcoin be mined in the U.S. I'm not sure how that's going to work out. But do we expect news today from the Vice President when it comes to policy proposals? This idea, for instance, to boost crypto in people's 401ks, or at least their ability to invest in crypto? Or is this a rah-rah, we're still on the team kind of speech?
I think it's mostly the latter, but, you know, you mentioned the 401ks, which is important because the Labor Department just a few minutes ago, about an hour ago, put out guidance essentially taking away earlier guidance that discouraged folks from using Bitcoin or crypto as part of their 401ks. Now, in that guidance, it said that they were neutral. So obviously, if you're in the crypto world, you want positive momentum, but at least it's not a roadblock anymore. The other thing that we could see come out is, you know, Senator Lummis just yesterday at the same conference said that she's going to put her Buy Bitcoin Act, if you will, on the floor, and President Trump is supporting that. Now, this bill would actually require the U.S. government to go purchase up to 5% of the world currency of Bitcoin. Now, I don't think this is going to pass. It's not going to get the Democratic votes, but if you're on the retail side, you want the U.S. government to go out there and actively purchase Bitcoin to potentially drive up the price even more. I'm just saying I don't think it's going to happen. I think it's more of a long game scenario.
Where are we on the 401ks before we move along, Nathan? The idea of this kind of institutional buying is what's been discussed for years. If the Trump administration, in fact, rescinds this Labor Department guidance that's not that old, actually, it's from 2022, discouraging effectively workplace crypto investing in a 401k, what would happen to the coin?
Well, guidance is just guidance. I mean, guidance is something that compliance officers read and they say, okay, that we understand how the Labor Department is thinking, but at the end of the day, it's regulations and laws that drives behavior. And so from the institutional side, you really need Congress to step in here. And there's two bills that they're looking at. The first is the Genius Act. Now, this is a stablecoin bill. I think it passes in June, July after it gets through some political roadblocks. But again, a stablecoin bill is not the big bill, not the broader market structure bill that the crypto world wants. That's actually a different bill that potentially could have a markup in June, but has a much longer path to success. So even though that there's lots of talk about guidance and changing regulations, the law is still the law. And if you're operating in the crypto space, you want regulatory clarity, and that most likely has to come from Congress.
Well, I'm glad you said that. You know, on the stage right now, they're talking about promises made, promises kept. How long should the people in that room in Las Vegas prepare to wait for a market structure bill?
So, you know, we've seen a draft discussion so far, and this came from both the House Financial Services and the House Ag committees, because the Financial Services owns the banks and the securities, House Ag owns the commodities and the derivative markets. Now, there's going to be a markup, probably, I've heard June 12th. Now, but the problem here with this market structure bill is that, yes, it would define what a security is versus what a commodity is. And I think there's bipartisan support for that. The problem is that when President Trump does get involved in crypto, that pushes a lot of the Democrats away from supporting this. And it raises the questions of, from the Democratic perspective, over Bank Secrecy Act, anti-money laundering. This is what we saw during the stablecoin bill. Now, the stablecoin bill was easier because there was a regulatory gap that most people agreed upon, but there are still a lot of Democrats out there, like Senator Elizabeth Warren, that felt that former Chairman Gary Gensler of the SEC had enough authority to police crypto, and the Congress doesn't need to do anything else. So, again, it's going to be a challenge. I think it can eventually get there, but I think it's going to be 2026. I don't think it's going to be this year.
If you're with us on YouTube or Bloomberg Originals, you can see J.D. Vance, the vice president, has reached the stage, and we'll let you know, of course, just like you're on the terminal, if he makes any news, if we have any headlines to talk about here. We're going to be discussing an hour from now, Nathan, all of this with Byron Donalds, the Florida congressman, who is, of course, running for governor in a state that is no stranger to cryptos, at this conference, as we learn that DJT, Donald Trump's media and technology group, is investing $2.5 billion, raising that money to invest it in Bitcoin. There have been a lot of questions, and we're going to talk about this with the congressman, about the Trump family involvement in this space. You and I have bumped into this story before, and the questions about conflict of interest. Maybe we'll slice this a little bit differently. Do these concerns slow the progress for crypto?
No, I don't think so, only from the standpoint of that Senate bill or that market structure bill that we just passed. So for, you know, if you think about who polices crypto, well, you know, the Commodity Futures Trading Commission has authority over fraud and anti-manipulation, but they don't have authority over spot markets. And this is where things get a little bit tricky. But I don't think the SEC or the CFTC is really going to take a heavy look at crypto. In fact, we've seen the SEC already pull back many cases against like Coinbase and Kraken and so forth like that. So the SEC and the CFTC aren't really much of an enforcement risk. And that's really where this crypto industry is at the moment, where, you know, you don't have the albatross of Gary Gensler hanging around your neck anymore. And that's a good thing. But nothing says 4 years from now, if they don't change the laws, nothing says that Gary Gensler can't come back. Now, I don't think he will come back, but nothing says that they can't come back. And then again, this enforcement risk increases. So for all the companies out there, and again, I don't want to be the naysayer and say that, you know, things aren't positive. It's certainly a much more positive atmosphere than it was under the Biden administration for crypto. It's just going to take a little bit more time to cook and a little bit more time for these companies on the institutional side to allow their compliance and risk folks say, yep, you can go ahead.
No one is better at this than Nathan Dean. It's great to see you, my friend. From Bloomberg Intelligence, our senior U.S. policy analyst, I should say, with apologies to Stumpy. We'll go in that direction. Nathan, come back and see us soon, and we'll keep tabs, as I mentioned, on the Bitcoin conference where J.D. Vance is speaking. President Trump about to hold forth in the Oval Office as well. So stay with us on the fastest show in politics. This is Bloomberg.
on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower, Wall Street halting its rebound, only hours ahead of the latest numbers out of NVIDIA. NVIDIA shares on a down day for the rest of the market, up now by 0.4%. S&P down 0.2 now, drop there of 13 points. The Dow is down 0.3. NASDAQ right now lower by 0.1%. The 10-year 4.49%, the 2-year 3.99%. Gold little change, down under 0.1%, 32.98 the ounce. And West Texas Intermediate crude up 2%, 62.14 a barrel on WTI. The big Bitcoin conference underway in Las Vegas. Bitcoin today down 2%, 107,368. Coming up after the close of trading, Salesforce, HP Inc. and NVIDIA. On Bloomberg's Ed Ludlow will be sitting down with NVIDIA CEO Jensen Huang at 6:30 p.m. Wall Street time on Bloomberg Radio. Balance of Power continues right now. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you so much from World Headquarters in New York. Charlie Pellet watching Wall Street for us here on Balance of Power. Thanks for joining. I am Joe Matthew in Washington here on Bloomberg Radio. On the satellite radio, channel 121, you can always find us on YouTube. Search Bloomberg Business News Live on the Bloomberg Professional app and on Bloomberg Originals. Right around this time yesterday, we were talking about going to Mars by the end of next year. That was, of course, the storyline coming out of Elon Musk, SpaceX, ahead of what was the 9th test launch of the Starship. They lost another one last evening. It did not go well. No chopsticks, no splashdown, and a lot of questions asked today about the future of the program, the trajectory to getting to Mars. It was a gorgeous launch at the outset, if you're watching here on YouTube, but also the future of Elon Musk's endeavors here. Ed Ludlow is with us, Bloomberg Technology co-host, in a special joint appearance with our friend Michael Shepard, Bloomberg Senior Editor for Technology and Strategic Industries. Gentlemen, it's great to have both of you with us. And Ed, I'm going to start with you on what is NVIDIA Day. I want to get there as well. But can you start just by telling us what went wrong? A lot of people got in front of their TVs and terminals last night and did not see what they were expecting.
So first off, SpaceX would absolutely argue that not everything went wrong. You know, they will always say that the data gathered in the entirety of the exercise is of high value to them. You know, in between each of the missions, this was the 9th for Starship, they make hardware tweaks and refurbishments. And the Starship system is made of 2 parts. The pointy, shiny bit on the top is the Starship spacecraft. The bottom half is the Super Heavy booster. And on this occasion, that Super Heavy booster had actually flown before on Mission 7, where they did catch it using the chopstick maneuver. On this occasion, they did not even attempt to catch it. That was never going to be part of the goal. The goal was always to have a sort of hard splashdown in the Gulf. But their other mission objectives, they did not meet. They did not deploy dummy satellites successfully, and they had some other sort of outside mission parameters failures. But the questions you pose are the right ones about the future status and cadence of this project.
Well, that's right. I'm assuming... Mike, it's not 2026, although we haven't heard this from Elon Musk. By the way, did he address the troops? Remember, there was going to be a SpaceX all-hands kind of speech about multi-planetary. Remember, they postponed it. It never happened?
They postponed it, and then after the launch, it never materialized. Okay. He did respond on X, of course, where else, to talk about this, and he tried to put a positive spin on it, saying lots to learn, and he did try to point to some of the objectives that Ed just mentioned. And yet it's hard to escape the fact that this is the 3rd straight launch where they had some sort of